thing. So I've just hit record. Last we were talking about your state exam and the process of your state exam and your application and all that good stuff. And I may not have mentioned this, but I think it's important that we do. So when you're looking for the how do I do my application, what do I need to know about my state exam, under the welcome section in the online learning system, it's all in this ReLink book, Real Estate Licensing in North Carolina. And one thing about this book that we've discussed is how it breaks down the topics of the number of questions you can expect to see for your state exam. And the topics are as they relate to the syllabus, not the book. Now, the book follows closely to the syllabus. We better identify them as chapter 1, chapter 2, chapter 3, or unit 1. But the thing I wanted to make sure that we all were good on, when you go to PSI Testing Center, the exams that are ministered are like, they have so many questions. I mean, they have thousands of questions in the test bank. And every time somebody sits down to take a test, it's like a new scramble of those questions. So in other words, if you have to go back, you're not going to see the same exam again. You may see a similar question, the same question, but for example, they say you can expect to see, let's look at agency. They say you can expect to see, where is it? Here it is, agency. This is unit 7. They say you can expect to see 22 questions, but you all are not going to see the same 22 questions on agency. There's probably 1,000 questions on agency. And when you sit down and take the test, it's going to scramble and it's going to pull 22 questions. The next time you go back, the next time you go back. So the reason they give you this book, because I don't know what's going to be on your test, because I don't know the scramble. What I do know is that we have the syllabus and we have this as our guide to help us study of our weight. I can't tell you the specific questions you're going to see on agency, but I can tell you can expect to see 22 questions. The reason they do that, you guys, is try to prevent cheating. They don't want me to take the exam and then walk out in the parking lot and tell you what's on the test. Does that make sense? So what they're telling you is the number of questions on the topic. And that's why we don't focus on specific questions, because, for example, the midterm, you're never going to see those questions again. The important thing to get from the midterm was how did you do in each section? Because you can expect to see questions on that section, but I can't guarantee what questions you're going to see. Does this make sense? So just know it's a scrambled test bank. You're never going to see the exact same exam twice. The other thing about the state exam, when you guys go to PSI Testing Center, they have what's referred to as, I call them test the test questions. So there's going to be a handful of questions in both sections that don't count for or against you. You are vetting test questions for future test takers. Do you know where your test questions came from? Past test takers. So every time somebody goes to PSI Testing Center, they vet new questions. If 100% across the state of North Carolina get it right, they need to do something. If 100% across the state of North Carolina get it wrong, they need to do something. So that's what they're doing when they're vetting these. So again, there's just a handful of questions that aren't going to count for or against you. You'll never know. You'll walk up from that exam going, well, how did I know what was my vet question? And that's the point. So you're just helping future test takers as past test takers helped you. Yes, PSI does have some practice tests. Thank you, Morgan, for bringing that up. PSI does have some practice tests. You may want to consider hanging off on PSI Testing Center until those exams, practice tests, until you are preparing for your state exam, because that's more what that's geared towards. So once you get the email from PSI introducing themselves to you, they'll let you know about their products and what they have for sale, and you can consider getting some extra practice there. As far as we're concerned for our end of class exam, we follow the syllabus, but we're not necessarily, I'm not guaranteeing you the number of questions on our exam. I can tell you the weight is about the same. So on my exam, can you expect to see a lot of questions on agency? Yeah, something about 7, 8, 9, and 10, right? Okay, so so the weight is going to be the same. If you want to know what's going to be on my exam, and some of you may have already found this, when you look in the Julie folder, when you look in our Julie folder, I have a PowerPoint in here called End of Class Exam Review. So what's going to be on our end of class exam? Ta-da! So you may want to start looking through this. You may want to start, I'm not, some things you guys may need to go back through and look up, and that's the point. But you may want to start looking through this. We're getting closer and closer, aren't we? So just kind of be thinking ahead about where we're heading. Another thing I want to mention, some of you may be looking for additional or supplemental study material. Please, please, please don't go looking for extra study material in Google. I cannot guarantee you what you're going to find. I can't even guarantee you're going to find North Carolina stuff. You go to Google, you might find Florida State stuff. So if you've been through the book, if you've been through the online learning system and you're looking for additional supplemental stuff to study, Lane and I do have some recommendations, things that we have experience with, a little bit more reliable than Google. I will go ahead. The author of your textbook is Dearborn. If you guys look in your book and you see in the bottom, what is that? Bottom left, I get bottom. Yeah, whatever. Left and right's hard. Dearborn is the author of your book. And Dearborn has an app. And you can, I don't know what the cost is, but you can purchase the app and they can give you, they'll have like interactive questions, like what you have in the online learning system, where you answer a question and it gives you an explanation. So Dearborn has an app. You may want to look into that, consider that. Another resource you may want to consider looking into. In the packet of stuff you guys got from Lane when you first registered, may have been a flyer for Exam Smart. I know it looks backwards for you guys, but is a flyer for Exam Smart. They too have really good information, good extra practice quizzes. Again, there's a cost. I don't know what that is, but you may want to look into if you're looking for additional stuff. Guys, if you haven't done the book and you haven't done the online learning system yet, please don't spend any money. These additional supplements are for those of you that have been through and you're looking for something more, something extra. I always encourage you to utilize the tools that we provide as part of your registration. I mean, the truth is you can spend a whole bunch of money on supplemental stuff, but if you never pick it up, if you never utilize it, it's not going to do you any good. So utilize what you got already available. And if you're looking for others, consider Dearborn, consider Exam Smart. If you want something else, just reach out to Lane. Lane knows more than I do. But she may have some additional suggestions to make as well. Questions? Good morning. Had you guys found this yet? End of class exam review? A couple of you? It's like an Easter egg until I point it out to you.
I had a question about, I know the last class, I think it was, you mentioned that on, and maybe I might have misheard you, but I thought it was the midterm. Once we finish, it'll give you a breakdown of kind of what sections you missed the most questions in. Was that for the midterm or the end of class?
Yeah,
exam?
did you not get that email?
I didn't, oh, well, I didn't check my email.
Okay. So check your, once you take the midterm, you guys should have gotten a report. It says, this is how many you got right in unit 2. This is how, when you look at it's got parentheses and a number in it, that number in parentheses is the unit. So this is how many, this is how you did in unit 7. This is how you did. So if for some reason you didn't get that report, please reach out to me outside of class. Don't put it in a chat. I will never see it again. So
Okay.
if for some reason you didn't get that report, just shoot me a text or an email and I can forward it to you. But I'm never going to see it in a chat.
I got it. Okay, cool. I didn't, I saw the email alert, but I didn't actually open the email. Okay.
Gotcha.
Thank you.
And that's good, Joy, because that can help you again. You know, the whole point of the midterm is like a checkpoint. You know, where are you? So use that to your advantage, you guys. Like I said the other day, the midterm is not for me. The midterm doesn't do me any good. So I hope we took it seriously. I hope we now have a really good idea of where we are, what we need to do. Because again, we're down to, let's see, it's 8 and our exam is the 31st. So what are we sitting at? 3.5 weeks, give or take, roughly, something like that. So hang on to your hats, y'all. We keep moving forward. Other questions or comments? The other thing I have, we left the call open last class for those of you that wanted to be in a study group so you could connect and exchange emails, phone numbers, whatever. I hope those of you that wanted to join were able to do that. I apologize, but I forgot to remind you guys. So I'll leave the call open again today. And that way, if you guys still want to connect, and this is your reminder, because I probably won't remember again. But if you want to connect with the study group or form a study group or whatever, I'll leave the call open after class today for you guys to exchange contact information so you can figure out if you want to meet. And, you know, in person may not work because we're not all in the same place. So we may need to think of some other platforms to meet. You could do, I know former classes have done like a closed Facebook group. Somebody would have to create it, of course. You could also do a WhatsApp, for example, or, you know, schedule time just to get together on a platform and meet. But however you guys decide works best for you. So again, I'll leave the call open. What else? Yeah.
I don't recall if you had said this, and I'm sure you would have gone over it again if it was out there. But is one of the tools that you have by chance like a listening tool, like, you know, like an ebook that you can listen to, like when you're driving?
Delane's got on her website, she's got a store. And one of the products in her store, Carolina School of Real Estate, where you guys registered. And I think if we look under pre-licensing, yeah, under pre-licensing, this passed the exam by Ann Rashid. Annie's one of our instructors here as well. She does pre and post and CE. And so she has an audio book that's available on Lane's website.
Okay.
And then of course, Lane has, what is this? Exam prep, you know, again, just things that you guys may want to look at. So yeah, this is Annie's audiobook.
I thought I
don't
saw
know if Lane
something
has other
somewhere.
resources.
Okay.
Yep.
Because
So
I'm
you
always in the car. So, okay.
Yep.
Thank you.
Yep. Thank you. Vaughn's already got it. Good. Now you just got to listen to it, right? So many times, yeah, I'll meet a tutor sometimes and they show up with like 5 books and all these accounts and logons. And I'm like, wow, you're busy. And they're like, well, I haven't really got a chance to do anything with this yet. Just think it through before you open your wallet. Don't run out and buy it all. Remember, we only have 3.5 weeks left. So just think it through before you open your wallet. Remember, you got more money to spend at PSI Testing Center, you know, getting your license, post licensing, etc. So just be conscious of that. Thank you, Mary. Anything else? Are we ready to put our mortgage lender's hat back on? Yay! It is what it is. All right, so let's get back into our lender units. And we are still in unit 14. So we're going to keep talking a little bit more. We do have some more math to do today, a little bit more in 14, and then we'll see how far we get in 15. But another math that we need to stick to, remember, we're thinking through the eyes of the lender. And one thing that the lender asks themselves on a regular basis is, what is my loan to value ratio? And what the lender wants to know is, what is their ratio? What is their part when you're comparing the loan to the value? Now, we're going to talk about value in just 1 second. But my T-bar fans, one way we can help remember our loan to value ratio, if I give myself some room here, we can remember the loan to value ratio with one of our T-bars. And all we're saying with the loan to value ratio is that the loan is part of the value. And that gives us the lender's ratio. So what do we mean by this? Our loan to value ratio. So let's say, for example, you are, and I'm going to make my numbers up on the fly, so we know how that goes sometimes. But let's say you are buying a house for $550,000. The value of the home you want to buy is $550,000. And you go to the lender and you ask for a loan for $480,000. Everybody with me so far? You want to buy a house, it's $550,000. And you call a lender and say, I want to buy a house. Can you lend me $480,000? And the first question the lender is going to ask themselves is, what is my loan to value ratio? So the back fourth line on the T-bar means divide. So when you take 480,000 and divide it by 550,000, I get 87%. So through the eyes of the lender, their loan to value ratio, what you're asking them to bring to the table is 87% of the purchase price. If the lender's bringing 87%, how much are you bringing? Yeah, 13%. Remember what we said the other day, who has the bigger interest in this property? At first, it's not you, is it? The lender's got the financial interest in this property. You call it home, they let you live there, but there's a reason why they file a lien to protect their interest, because they have an 87% interest while you only have 13%. Now, back to our principal and interest picture on page 394. You're going to start by paying the lender. You pay a little bit of principal and a whole lot of interest. And as time goes on, you pay more and more principal and less interest. Once we kind of reach that halfway point in the chart there, usually about year 15, unless you're paying it off early, now the lender's interest starts shifting where they have less of an interest in the property. You have more invested, but guess what? They still have an interest. Until you pay them back this $480,000, they will have an interest in the property. So loan to value ratio answers the questions for the lender. What do they want from me? Of the purchase price, of the value, what do they want from me? So now if we talk about what this value is, value, the lender defines as either the sales price or the appraised amount, whichever is less. So many times I ask you guys, what is value? You'd be like, appraised amount. Well, I don't know until I see the numbers. See that it's the sales price or the appraised value. The answer to that question is whichever one is less. So let's talk about what this means. Let's say you're buying that house and your sales price is $550,000. The lender pre-approves you for $480,000. You don't have loan approval yet. You are pre-approved for $480,000. Part of your approval process is having an appraisal done, and we're getting there. We're talking about all that. But part of the approval process through the lender is to have an appraisal done for the appraiser to come in and offer their opinion of value. So the appraiser comes in, they crunch their numbers, and they determine that the property appraises for $525,000. Which one are you getting loan approval on? The one you're getting loan approval on is the appraised amount because it is less. Wait a minute. Aren't you contractually obligated to pay the seller $550,000? Yes, you are. That's your contract price. That's what you guys agreed to in an offer to purchase, and it became a legally binding contract. Now the appraiser's coming back and saying, yeah, no, it's not worth 550, it's worth 525. This is the most recent market we were coming out of still. Homes were going under contract for a lot more than what they were appraising for. So what happens? Well, it's not over yet. We don't have to terminate yet. The lender's only going to issue the loan on the appraised amount. And that means we have a difference of $25,000 that we got to figure out where that money's coming from. So what are our options? As a buyer's agent, I'm going to call the listing agent or the seller and ask them if the seller would be willing to renegotiate the purchase price. Would the seller be willing to reduce the purchase price? They're willing to come down $25,000. Doesn't hurt to ask, does it? Is the seller legally obligated to renegotiate that purchase price? So I can make an offer for the seller to reduce the purchase price, but the seller's got three choices, don't they? They can accept it and agree to lower their purchase price. They can reject it and say, I'm not budging. Or maybe they counter it. Maybe they say, I'll lower it $12,500 and you got to come up with the rest. You guys with me? This is round 2 of negotiation. We already got this thing under contract. Now we're entering into the ring again, aren't we? And we're in round 2 of negotiations. Understanding the seller's not legally obligated to consider, but we can always ask. If the seller says, nope, I'm not going to lower the purchase price, now the buyer's got to come up with the difference. Maybe they got to come up with the 25,000, or maybe we negotiated that. Now the buyer's got to come up with 12,500. Where do they get that money? Well, this gets tricky. Best case scenarios, they have that money laying around. Now, I don't know about you guys, but I don't have $25,000 laying around. So if I was buying this house, it's get a little challenging, right? Your buyer, and I'm not speaking specifics because I don't know your buyer and I don't know your buyer's lender, but probably your buyer won't be able to get a loan for that amount because they're already trying to get a loan off of this amount. And it's awfully hard to get 2 loans to buy a house at the same time. They can try, they can have a discussion with the lender, they can go to the bank and they can try to borrow $25,000, but they're going to have to jump through more hurdles because now they're trying to get 2 loans to buy a house. One for the lender for the loan to value ratio, their down payment, and then the other one for this $25,000 loan. If the lender says, no, you're not approved to get another loan, you cannot get a loan for this $25,000. And by the way, you guys, that includes a loan from a private source. And an example of a loan from a private source would be the bank of mom and dad. So even if they want to go borrow money from mom and dad, the lender may not approve it. Now, is there a difference in borrowing money and gifting money? Borrowing indicates you have to pay it back. Gifting says, happy birthday. So mom and dad might be able to gift the money. They might be able to give it a gift. The lender will make mom and dad sign something saying this is a gift. And if mom and dad lie, that's called loan fraud. And loan fraud's really bad. We'll talk about that a little bit in Unit 15. But guys, bottom line, if the seller's willing to budge from the purchase price, the buyer doesn't have or can't come up with $25,000, game over. Because we don't have the numbers don't match. The buyer's not getting loan approval for this transaction. Does that mean they would get earnest money back or no? If we terminate within due diligence. So as long as we terminate for failure to get loan approval while we're in due diligence, worst case scenario, nobody likes to terminate. I just put that out there. Nobody likes to terminate. But as a buyer's agent, if we have to terminate, best case scenario, we can do so within due diligence. So at least I can get my guys their earnest money back. That's the best I can do for them. If we find out after due diligence that our buyer's not getting loan approval, then no, they're not getting their earnest money back. Remember, if they terminate for any reason after due diligence. So buyers, this crazy seller's market we were coming in. I mean, let's just say we said the property appraised at 525. Let's say it was listed at, 530, whatever. Buyers were coming in this last market. I'm not kidding. And offering amounts of money way over asking price or way over the appraised value. Buyers sometimes were signing documents saying that they weren't going to terminate because they know darn well it's going to appraise for less than $600,000. So buyers were signing something saying, I'm not going to terminate based on this. So basically what they're saying in this case is they got $75,000 laying around or access to that $75,000. That's another thing that made this market so unique. Was the buyers were driving up those asking prices, those listing prices, and they had to have the money. They had to come up with the difference from somewhere. Because remember, if the seller is getting 30 offers, they're not worried about this buyer terminating. Because if this buyer terminates, they got 29 other people standing in the front yard with an offer in their hand going, pick me, pick me. So sellers didn't care if buyers terminated. Again, that pendulum swinging back. And as we get in a buyer's market, sellers are going to care more and more about buyers terminating. Questions? Oh, I didn't mean to do that yet. There. North Carolina has something called usury laws. Understand, lenders are allowed to set whatever rate they want to. Lenders are free to decide what type of loan product they want to offer. They're free to advertise or let consumers know the various terms of the loan product that they want to offer, interest rates. Lenders are free to set all that themselves. All lenders are different, kind of like all real estate firms are different and all agents are different. So are lenders. So again, having a tool belt of lenders on you, because each buyer may have a different need. So getting to know lenders, which you will, getting to know lenders and the products they offer is another way to help your buyers. With that being said, even though lenders have the right to set their own rates, usury laws put a ceiling on them. And usury laws say you got freedom to do what you want to do up until this point. So they help keep everybody reasonable. They help keep everybody from, jacking up interest rates to 25% or something absurd like that. I don't know how that lender would get business, but it puts a ceiling on these terms to help keep it a more level playing field for the consumer. Another thing a lender has charges, and there's certain charges that they're going to charge the borrower at closing. As we get closer and closer to Unit 21, we're going to talk about all the buyer's expenses, all the debits, the money they have to bring to closing. And one thing that falls under that category is lender charges, lender fees. And one lender charge that they may charge the borrower at closing is for something called discount points. Discount points are only prepaid interest. Please write that down real big. Discount points are prepaid interest. This is one of these things you guys like to make harder than what it is. So what is a discount point? You can look it up, find all sorts of definitions, and you can find pages and pages and pages about discount points. What is a discount point? Keep it simple. It's prepaid interest, meaning you are bringing an interest payment to settlement. You are prepaying interest. Now, some lenders require borrowers to purchase discount points. Some buyers may ask lenders in a roundabout way if they can purchase discount points. So whether or not the lender requires it, whether or not the buyer asks for it, what I do know is these are common. We see these quite frequently. So why in the world would a buyer agree to prepay interest? There's a couple reasons. When a buyer buys discount points from the lender, two things happen. It increases the lender's yield, which I will talk about it in a second, and it decreases the borrower's interest rate for the life of the loan. So let's say you go talk to a lender today, and the lender, let's get today's rate. The lender says, I can quote you an interest rate of 6.5%. And the borrower looks at the lender and says, is there anything I can do to get that 6.5% lowered? And the lender's answer is going to be, buy some discount points. You buy a point, it lowers your interest rate. You buy 2 points, it lowers your interest rate. We'll talk about all that math in a second. So from the borrower's standpoint, they're prepaying interest. The lender's not making any more. They're just collecting some of it early. They're still going to make the same amount of interest. They're not making any money here. They're just collecting it early. And in exchange for that, the borrower can negotiate a lower interest rate. And remember, that interest rate is for the life of the loan. It's locked in for the next 30 years. The other thing that the discount point does, it also benefits the lender, which is why some lenders request it. Now, let me rephrase that. Some lenders require it. Some lenders require borrowers to purchase discount points. And what it does for the lender is it increases their yield. Now, again, we're not in lender school, so we're scratching the surface on this. Somebody's yield is their return on profit. And through the eyes of the lender, the higher their yield, the more sellable this loan is to the secondary market. We said the other day that lenders sell loans to other lenders. We're getting there. We'll talk more about that as we get to Unit 15. But the lender has a product to sell, and they need to make it sellable on the market, the loan buying market. So if the lender, the higher the yield, the more sellable the product. So buying discount points not only helps the borrower lower their interest rate, but it also helps the lender increase the yield. So once this loan is originated, once this home has been purchased, the lender can sell, they have a more sellable product to the secondary market. So that's the what. Now let's talk about the math piece of discount points. And there's two different maths with discount points that we need to go over. The first math we will see again in Unit 21. We will see it on your end of class exam. You will see it on your state exam. You will see this again. The first piece of math with discount points says, how much does the borrower have to bring to closing? How much of prepaid interest are they paying at settlement? And the formula to figure discount points, to figure the amount to charge the borrower on the settlement statement, is by looking at the number of points. If the lender's charging the borrower 1 discount point, that's going to shake out to 1% of the loan amount. What do we say the word of means in a math problem? Multiply. So how do you find 1 discount point? You take the loan amount times 1%. That's how much your borrower is bringing for discount points. If the lender's charging 2 discount points, it is 2% of the loan. If the lender's charging 3.5 discount points, it is 3.5% of the loan. Everybody see where we're going with this? The number of discount points is the percentage of the loan. Please make sure you see that loan amount. Lender charges are always of the loan amount, not the purchase price. The lender cares about their money. Their money is the loan amount. So all lender charges are of the loan amount. So the buyer says, I want a lower interest rate, or the lender says, I want a higher yield. Let's charge some discount points. The question is, how much do you charge at settlement? The number of points shakes out to the percentage of the loan. We will see this again in Unit 21. You'll see this on both of your exams. Questions on this? This is going to be a debit to the buyer at settlement. The second piece of discount point math you may see. Can't make any guarantees, but you may see it. The second piece of discount point math asks the question, how much, if I buy one discount point, what's my new interest rate going to be? And what's the lender's new yield? So once you buy that point, the second piece of math is, how does that affect my interest rate and their yield? And to help us understand that, I like to think about pie. And if we take our pie and we divide it into 8 pieces, discount point pie is always 8 pieces. When the buyer buys a point, they are buying one piece of pie. If the buyer buys 2 points, they're buying 2 pieces of pie. If they buy 3 points, they're buying 3 pieces of pie. Discount point interest rates and lender yields are discussed in terms of an eighth, terms of eighths. So that's why our pie has 8 pieces. If they're buying 1 point, they are buying down their interest rate by 1/8%, and the lender's yield is increasing by 1/8%. So let's go back to our example. Well, first off, before I do that, you guys know I'm a fan of math. Yes, as much as I like math, I hate fractions. And I hate the word hate. But you know what? When it comes to fractions, anybody with me? So the first thing I do when I see a fraction is I convert that sucker to a decimal. So if we take 1 divided by 8, I'm going to get 0.125, which is a number I can work with. So whatever you're looking at, your number of pieces of pie, 2 8s, 3 8s, 4 8s, however many pieces of pie, we can take that number, divide it by 8, and get a number we can work with. So now if we go back to our example, let's first look through the eyes of the borrower. The lender quoted the borrower an interest rate of 6.5%. And the borrower said, is there anything I can do to reduce that interest rate? Is there anything I can do to get this interest rate lower? And the lender says, buy a discount point. If they buy 1 discount point, the borrower is lowering their interest rate by 1/8% or by 0.125. So if we take 6.5 minus 0.125, we now have a new interest rate for the life of the loan of 6.375. You were quoted 6.5%. You bought a discount point, which means you brought some money to closing, 1% of the loan to closing. And as a thank you for that, if you will, your interest rate for the life of your loan is going to be 6.375%. The lower interest rate means the lower monthly payment for the next 30 years. So discount points decrease the borrower's interest rate, in this case by an eighth. 1 point decreases it by an eighth. Through the eyes of the lender, they're dealing with the same numbers. They too started with an interest rate of 6.5%, but once you buy that point, they're going to increase the yield. So now the lender's new yield is going to be higher. And this is a more sellable product on the secondary market. How did I get the 6.375? I took 1 and divided by 8 to get 1.25. They bought 1 point, which shakes out to 1/8. 1 divided by 8 gives us 0.125. So we took the interest rate that we were quoted at, 6.5%. We deducted the 0.125 for the prepaid interest for the discount point. And now the borrower has a new interest rate of 6.375. We added that 1/8, that one piece of pie to the lender's yield. So now when they go to sell this product, they have a yield, they have a return on profit of 6.625. Most lenders sell the loan, which means they got to collect their money up front, because we aren't sticking around for 30 years much anymore, are we? We're not living in homes for 30 years. Even if we do take off a 30-year loan, most of the time we get it paid off sooner. I mean, even if we put down $20 extra a month, for example, that's going to get it paid down sooner. Most of us don't have a loan for 30 years anymore. So the lenders want to collect as much as they can before they turn around and sell your loan. This is going to increase the yield. They have their money of that prepaid interest, and then they also have a more sellable product on the secondary market. Yes, ma'am, Kiki.
So the yield is when the lender sells to another lender, correct?
That's it.
Not, okay.
Yep. Somebody has a friend that bought a 1/4% of a loan. Does it depend on the lender? Yes, all lenders are different. All lenders offer a different product. They offer different terms. How negotiable are they in their terms? They're all different. Again, you guys, this is so important. Why we encourage our buyers to shop around for lenders. It's not like you talk to one and you know this is going to be your loan terms. Lender or borrowers are encouraged to talk to a couple so they have something to compare and contrast. And bottom line for the borrower, they got to look at, what's best for me now to purchase and what's going to be best for me now over the next 30 years that are however long I'm paying this thing back. Discount points are just prepaid interest. First piece of math, you will see again. This is important about the second piece of math. You may see this again. Please, everybody listen. You don't need to worry about adjusting the interest rate or the yield unless the problem specifically asks you to do it. If the problem doesn't specifically say, what is the new interest rate or what is the new yield, then you don't need to worry about discount point pie. Is that good? When we get to unit 21, we're going to see the borrower got an interest rate of 6.375. When we see that in a problem, we are going to assume this is the bought down interest rate. We're going to assume that this is the new interest rate unless we are asked specifically to find this. So what I'm asked to repeat. So you don't need to worry about discount point pie unless you're specifically asked, what is the borrower's new interest rate or what is the lender's new yield? The interest rate you see is the adjusted interest rate unless otherwise asked. Everybody hear me? I got about 3/4 of you bobbing your head. So the other quarter. So we just covered the loan to value ratio, figuring out the loan amount, for example. We just covered discount points. We talked about discount point pie. So now what we're going to do is give you guys a problem. Go ahead and set your chats to private, just to me. And I actually got this is a 3-question question. So y'all take I know, right? Good time. So y'all take your time, watch your time, but take your time. First thing you need to do is use your loan to value ratio to find the loan amount. Remember, all lender fees are based off of the loan amount. So they give you the purchase price, they tell you the lender's loan to value ratio. So we first have to use that to find the loan amount. Then once we know the loan amount, we can determine how much the buyer's purchasing, what their new interest rate will be, and what their new yield will be. And please tell me in a private chat the answers to your 3 questions. And I need to hear from everybody, please. Got one more minute and then we'll talk about this. Well, you guys are finishing up. It's not going anywhere. Okay. So let's see what we got. Let's start this through as we're finishing up. We're given some information about the problem. We know the purchase price is $265. The buyer's obtaining an 80% conventional loan at 4.5% interest rate, and they're going to purchase 2 discount points. So the first thing we need to do is find our loan amount, because we got to know the number that we're working with. The loan amount, loan to value ratio. So we know the value, in this case, is the purchase price. We know the lender's ratio is 80%, which means they've agreed to bring 80% of the value. So now the question is, what is the loan amount? So when we take 265,000, the up down line on the T-bar means multiply, and we times that by 80%, we get a loan amount of $212,000. So we used our loan to value ratio. We know how much you're going to pay for it. You've agreed to pay 265, the value or the appraiser, whichever's less. We know the lender has agreed to bring 80% of that value. So now the question is, what's the exact amount that the lender is bringing? What is the loan amount? Questions on how I got the 212,000 loan amount? You good so far? Okay. Now we're told that our borrower is going to purchase 2 discount points. 2 discount points will shake out to 2% of the loan amount. So we know our loan amount of 212,000. This borrower has agreed to bring prepaid interest to settlement in the amount of $4,240. So to answer the first question, how much is the buyer paying in discount points? They will have a debit. They will have a charge to them at settlement for $4,240. Understand, the buyer's going to have to bring the 20%, right? That's their down payment. They're going to have to bring that, but they got other charges as well too. So they got to bring more than 20% to the table. And that's where we're heading in Unit 21 to look at all of the buyer's debits. One of these would be a debit to the buyer for a discount point of $4,240. That's okay. That's okay. So the answer to the first question is, how much in discount points will the borrower pay at closing? $4,240. Yeah, did I just hear?
Oh, okay. So I thought that the discount points would be paid directly from the buyer to the lender, but I'm assuming it goes from the buyer to the attorney, then to the lender?
Nope. They pay it all at settlement. So they bring all the money at settlement and then it'll be dispersed. It'll be distributed from settlement.
Okay, but it's not necessarily like,
Do what?
Sorry, somebody was calling me. It's not necessarily like they pay it directly to, like at settlement, it goes directly from the buyer to the lender, or it goes,
The attorney collects all the money at settlement and then they distribute it to the lender, the agents, the seller, right? Everybody that's standing there waiting to get paid. So
Okay.
the lender can't collect this $4,240 if we don't close. So that they can't collect it up front. They can only collect it as part of those closing funds. Because
Okay.
if we terminate, if the buyer wakes up the day before settlement and says, yeah, no, I'm not buying this house, the lender's never going to get that $4,240.
okay.
So
I
they
was
don't get,
paid and once it was agreed upon and you,
Nope.
Okay, but not until close. Makes
Yep.
sense.
lender doesn't make much if we don't close. You and I don't make much if we don't close. The attorney doesn't make much if we don't close. Because remember, I mean, there's only two people to the transaction, right? And the whole gist of this thing is the buyer's paying the seller. So that's the monies we're dealing with. So if that piece never happens, if the buyer doesn't pay the seller, then we have no money to deal with because that never changes hands. So we can't charge lender fees. Good question. So our first question, how much in discount points? This buyer is going to bring prepaid interest of $4,240. The next is about the new interest rate and the lender's yield. And that's where we can draw pi. Remember, discount point pi always has 8 pieces. And the reason why is because discount points are calculated in eighths. So this buyer is buying 2 discount points, which means their interest rate is going to decrease by 2 pieces of pi. And 2 pieces of pi, 2/8, 2 divided by 8 shakes out to a quarter, 0.25%. So use the pi to help you see how many pieces and help us get that 2/8. If you're visual and it helps, draw out the pi. So 2 discount points means 2 pieces of pi. 2 pieces of pi is 2/8. 2 divided by 8 is 0.25. The borrower, this is for the borrower, they were quoted an interest rate of 4.5%. They've agreed to buy 2 discount points, which means they're going to reduce their interest rate for the life of the loan by 0.25%. So the second question is, what is the borrower's new interest rate? They will have a new interest rate locked in at 4.25% for the next 30 years because they brought the lender $4,240 of settlement. The lenders understand they're not making any more money. They're not getting a bonus of $4,240. This is prepaid interest. This is interest that the borrowers agreed to pay anyway. They're just agreeing to prepay some of it. And as a thank you for prepaying interest, we'll reduce your interest rate for the life of the loan, meaning you have a lower payment for the next 30 years. So the borrower's new interest rate is going to be 4.25%. And then the third question is, what does that mean for the lender, for their yield, for their return on profit? Again, we're all starting at the same place. We're all starting with the same number. It decreases the buyer and it increases the lender. So what's their new yield? We start at the same place. We add to the lender's yield, which gives the lender a new yield of 4.75%. And again, all that means they have a more sellable product when they go to service your loan. And we were talking about why they do all that. I promise we're getting there. As soon as we start 15, we're going to talk about why the lender sells your loan. So the lender's new yield will be 4.75%. Questions?
That's one I didn't remember was step 3. And I blanked out on it. I knew that there was a profit in it when they sold it, but I drew a blank.
So, yeah, and that might be a good, because, decrease for the borrower, increase for the lender, right? Kind of thing like a
So-
teeter totter.
And I know you said we're gonna get to it, but are they passing on that profit to whoever they're selling it to? Is that,
No, that's their money.
okay,
That's one way lender, because they're originating the loan and then they're selling it. So the only money
Right.
they're gonna get is at the origination. So
Okay.
they're that helps pays their bills and their admin and copy paper and power and internet, right? All their bills and everything. So that may help. And that may be another reason why the lender requires it, is because they need money.
I just don't understand because it's showing up at 475, which is more than we ever saw, so. I
Right,
guess that's.
because they have some of this, and maybe they do have to give some of this when they sell it. Maybe they do put some of that in the piggy to help with this 4.75. But what we need to know is about that yield. The higher the yield, the more sellable the loan
Okay,
through the eyes of the lender. I think I asked this the other day, but do I have any mortgage lenders? Sometimes I do. At least none that want to fess up. Okay, that's okay too. It's not uncommon for me to have a mortgage lender. Again, you guys. Yes, ma'am, Pedrea.
Can you just repeat what you said about the yield for the lenders?
It increases the lender's yield. When you buy discount points, it increases the lender's yield. And through the eyes of the lender, the higher the yield is just their return on profit. It's their return. And through the eyes of the lender, the higher the yield, the more sellable it is on the loan market. They have a more sellable product when they have a higher yield. It's kind of like selling a house, right? You want the most sellable house. You want to do what you need to do to make it look more attractive on the market than any other house on the market, right? So this is one way that the lender can make their loan look more attractive than any other loan on the market. Because the people buying this, the lenders buying the loan from the lenders, are buyers. Sellers and buyers, it's just a matter of what product we're buying and selling. And no matter what you're selling, you want it to look sellable to the buyer. You want it to be attractive to the buyer. So by increasing the yield, they have a more sellable product. We will in just a minute. Never fear. I got plenty of practice for you guys. You guys never worry about if I give you practice. We're going to talk a little bit more in unit 14. Not specifically about this, but rest assured I got plenty of practice. Please hear me. You don't have to worry about adjusting the interest rate or the lender's yield unless the question specifically asks, what is the borrower's new interest rate or what is the lender's new yield? Is everybody good with that? Let's take a break. We come back. We're close to wrapping up unit 14, so we'll wrap that up and then we'll get going in 15. Welcome back. All right, so we are taking attendance. Oh, Joseph, I just got you. Okay. Again, we got practice for you guys in the book. I'll show you all that in just a second. Also remember too, we're recording. So if you want to go back through at your own pace, you have the ability to do that. Just a few more things to say in unit 14. And we'll thank you for letting me know that you're back, and we'll wrap that up. The lender may charge a discount point. It's not required, it's not on every single transaction. They may charge a discount point. There's another fee that the lender will always charge. And the fee that the lender will always charge is called the loan origination fee. And this is the fee that they charge to originate the loan. They got to process it, do the paperwork. They have, like we said, admin, they got to pay a power bill, they got to pay internet, they have to pay their bills as well. So they're going to sell this loan, they got to make something. So we'll always see the loan origination fee. The loan origination fee is a percentage of the loan amount. And the problem has to tell you what that percentage is. So all you have to remember with this is they give you a percentage for the loan origination fee. You take that times the loan amount, and there is your, or the lender's loan origination fee. So we're looking at our purchase price, still $265,000. We're still dealing with a loan to value ratio of 80%. So our loan amount is going to be the same as what it was, $212,000. Tell me in a private chat what the lender is going to charge this borrower for a 1% loan origination fee. I love it when y'all answer my questions with a question. Like, are you asking me or are you telling me? Okay, so first thing we need to do is find the loan amount. The problem maybe give you the loan amount, maybe they don't. If they don't give you the loan amount, they got to give you the purchase price and the loan to value ratio. So if they don't tell you the loan amount, we now know how to find that. So same as before, our value in this problem is 265. The lender's ratio is 80%. And so what we don't know is the loan amount until we take 265,000 times 80%. We get a loan amount of 212,000. This lender is charging a loan origination fee of 1% of the loan amount. So this borrower, another debit to the borrower that we're going to see at settlement, will be a charge for $2,120. This, the lender does get to keep. That much I know for a fact, because again, they got to process There's people involved, manpower, right? So this I know for a fact that they will get to keep, so they can, pay their bills. As far as if they get to keep the discount point amount when they sell the loan or not, that I'm not sure about. But again, it kind of makes sense, but I'm not exactly sure how that piece works. So we could be looking at a couple different lender fees when we get to unit 21. We could be looking at loan origination fee. We could be looking at discount point. So we'll see all these again. Questions on this? Loan amount times 1%.
I'm assuming the origination fee is non-negotiable.
Right?
Okay.
Yep,
But
all
the-
lenders charge different, so that, again, another good reason to shop around, talk to a couple different to see their product. Yep. It's usually somewhere between 1% and 2%. You're not going to see a lender charging a 15% loan origination fee. If they do, they won't be in business long. But again, they're all different. Yep. The last little piece of unit 14 is just talking about some different repayment plans, some different options that the lender may have considered. So what we've been talking about so far is the fixed rate level payment, which means that rate, when you see rate in lender speak, that's almost usually referring to the interest rate. So what we've been talking about so far is a fixed rate level payment, meaning once that interest rate is fixed, that's going to be our interest rate for the life of the loan. There's some other repayment options, some other repayment plans. Lenders may charge an interest only, which means the payments, the borrower is only paying interest. Once they make the last interest payment, they have one lump sum due. And that one lump sum due is the principal, the amount that they borrowed. So the only payments that they're making is on interest. They make that last interest payment. They have one lump sum due, known as their balloon payment. Yeah, you know this going into it. Interest-only loans are best for short-term loans. So think like 3 to 5 year loans. You're not going to get a 30-year interest-only loan. And a good example of somebody that might, where an interest-only loan might be attractive, is a developer where they're going to buy multiple tracts of land, clear it, subdivide it, build on it, and then sell the houses. So to buy the land, they may use an interest-only loan, short-term loan, 3 to 5 years. 3 to 5 years from now, hopefully now they're selling houses. So they have that balloon payment. They have that principal when they purchase the land. Again, just one example. But interest-only or short-term loans. Another type of loan that you guys have probably heard about is the ARM, or the adjustable rate mortgage. And the ARM, the interest rate fluctuates. It's not fixed. The interest rate adjusts. It goes up and down, sometimes in predetermined points of time in the loan. There's a picture, in your book on page 399. And you can see that interest rate adjusting. So payments may also adjust as well. These could be a possible advantage to short-term ownership. If you're buying a home and you know you're not going to be there, but for a couple, 5, 8 years, something like that. Sometimes these are good products for loan products for military, Because military almost always can't stay in a home for 30 years. They get transferred, they get stationed other places. So this might be a nice, an attractive product for military, knowing that they're only going to be in the home for short term. So the interest rate adjusts, the interest rate fluctuates. There's a graduated payment mortgage payment plan. The graduated payment, your payments are lower at first, and then they increase or graduate at predetermined points of time. So you start with a lower payment. And as time goes on, your payment graduates, your payment goes up. A good example of who might use this could be like a startup business. You're starting a brand new business. You need to get a mortgage loan for your building, your commercial building or whatever. You don't have any money now because you're just getting started. But presumably, as you start making money, you can afford to pay more on your mortgage. With graduated payment mortgage, negative amortization is not unrealistic. Remember when we amortized last week and we did those 3 steps and we found our balance going into the next month? With negative amortization, that balance isn't going down. With negative amortization, that balance goes up at first because that payment you start with may not be enough to cover the principal and the interest. So instead of deducting from your balance for the first couple years, you might be adding to until you increase your payment and cross that threshold. A balloon payment is the final amount due in a non-fully amortized loan. So again, when you make the very last payment, old school, those payment coupon books. And when you tear out the last payment coupon book, you've made your very last payment, you still have a balance due. That balance due is your balloon payment. And then there could also be a growing equity mortgage repayment plan. We're going to talk about equity when we get to Unit 12, but equity is basically the money you have invested in your property. Equity is your money. Equity is this American dream of home ownership that we talk about. It's all about your money that you have invested in your equity. Again, more to come on that in Unit 12. So a growing equity mortgage then says, you start with this payment, principal and interest payment, and it's going to grow. And how it's going to grow is going to be determined on some agreed upon scale. So an example of agreed upon scale might be like the government's cost of living index. The government's cost of living goes up, your payment goes up. So we agree on what kind of scale, what kind of index we want to use, lender or borrower. And that's how you, one way you could grow your equity, how you could grow the money you have into the property. Again, more on equity, more to come. And that gets us through Unit 14. So you got those key terms back on page 363. You got your key point review, your checklist, your Cliff's Notes on 383. You got the student quiz on 385. We got some more practice for you in just a second. If you guys will, real quick, turn with me. Huh? My page numbers are off. I don't know how this happened. All right, Unit 14, the key point or key terms are page 383. Okay, 383. What the heck happened? Yeah, y'all know what? I got an updated book. So I'm finally seeing what you guys see. That was an exciting day for me last week. Okay, and then your key point review is 403. Weird. And then the student quiz is 405. Have I been off on these page numbers this whole time? No, it's been good. This is so weird.
This is, what you have on here looks, is right, according to our book.
What does your book say? Mine says 10th edition update. Is that what y'all says? Why
Yeah,
are we not looking at the same book? Weird. So weird. Okay, so the beginning of Unit 14 has key terms. The end of Unit 14 has key point review and student quiz. It sounds like Kiki, if we turn to page 387, let's see if we can do this. If everybody turns to page 387, is that the end of your Unit 14 quiz?
yes.
387 is the end. Okay, good, perfect. So I'm the one that's off. You guys are good. It's just me. Weird. Okay, on page 387, those last three problems, number 28, 29, and 30. Everybody see those? 28, 29, and 30. These problems, I really like these problems. Y'all want some good practice on this math in Unit 14? They build off of each other. So before you can answer 29, you have to answer 28. Before you can answer 30, you have to answer 28 or 29. So all that information builds off of each other. However, you don't have all the information that you need just yet to solve those three problems. So put them off to the side for now. By the time we get done through Unit 15, you will have that one last piece that you need to answer those last three problems on page 387. So make yourself a note to skip them for now. We won't get to them today, but we'll see those on, well, maybe we'll get to it today. But if not, we'll see it first thing on Thursday. Also math, some extra math in Unit 14. You got your math concepts. I'm assuming these page numbers are right. I think I'm going to go back to my old book until I figure this out. That's why you don't throw anything away right away, right? So I'm back on my old book. 380 is your math concepts. Kind of break down the math that we talked about. There's more math in Unit 14 than what you need for your test. So just stay focused on the math that we discussed. We amortized a loan. We talked about interest over the life of the loan, discount points, loan origination fee, loan to value ratio. And then you have those 15 or those 50 problems in the back of the book, starting on page 803. These are the numbers that relate to the problems that we just did in Unit 14. So there's some extra practice for you guys in the back of the book. We good? We got these? Practice, jot it down. Okay. But wait, there's more. If we look in the online learning system, in the Unit 14 material, you can see you got a quiz here. You got an extra finance quiz. Again, some of the math that we covered. Here's those 15 problems or 50 problems in the back of the book. And then there should be some more math in the Unit 14 quiz as well. So I do hope you're going through the online learning system along with class. So again, you can help gauge yourself and solidify this information. Y'all feel like you're drinking from a fire hydrant yet? Yep. Welcome to real estate. We just kind of throw you in the deep end, don't we? There you go. So that gets us through 14. So still with our lender hat on, still in financing, we go on to 15. And 15 is the more in practice. 15 is more of the unit that you and I can use when we're talking to our buyers and sellers. Because having an understanding of some of these terms and these ideas, we can have conversations with buyers and sellers. We're going to be encouraging them to shop around different lenders. We're involved in this process with your buyers. I mean, we start with them on day one and we go through the whole process. So while I'm not a lender, okay, guys, I need just 1 second, please. So if you're talking to your lender, if you're talking to your borrower, I'm not trying to be their lender. I'm not trying to be that knowledgeable. But I do need an idea. I do need a basic understanding, and that's where we're coming into in Unit 15. So our guide, our roadmap for this, we're going to talk about the different types of loans. We've talked about conventional, FHA, VA. We've mentioned them. So now we're going to talk more specific about them. We're also going to talk about these players in the lending game. There's several different players, so we're going to identify them and what their roles are. We're going to explain the lending practices and procedures. And then we do have a little bit more math in Unit 15. We're going to teach us how to qualify a buyer, how we could quickly qualify a buyer if a lender's not available. And then we're going to learn how to calculate your principal and interest. Let's do this. Private chat. We called your principal and interest something else. We're not going to call it principal and interest. Your test isn't going to call it principal and interest. Who remembers what else we call your principal and interest? Your monthly payment, not your PITI, just the PI, just the piece that you owe the bank. Anybody remember what we call what you owe the bank? That principal and interest? I'm
Petey,
getting pushed. I'm sorry?
are you asking?
Yeah,
Oh.
in the
it's just
chat.
like- Oh, okay.
If anybody remembers, what do we call our principal and interest? I'm getting a few of them. Good. Your principal and interest is also referred to as your debt service. Look at all those heads go, oh yeah, that's right. I remember that. Your debt service is your principal and interest. And guys, I think, y'all want my opinion? I think it is way too easy to say principal and interest on your test. You know what they might say? Debt service. So now we're all good. What do we call your principal and interest? Debt service. Perfect. Okay. So the problems we worked in Unit 14 gave you the debt service. They gave you that monthly payment. Not all problems are going to give you that. So the question is, how can I find my debt service? And that's the other piece of the math that we're going to do at the end of Unit 15. So let's introduce you to the real estate financing market. You may or may not remember, you guys may or may not been interested in real estate, but probably, let's see, what year is this? 23, 13, 15, 16 years ago, golly, 14 years ago, you may have heard of something referred to as the housing market crash. Anybody remember this? Anybody feel it personally? Anybody see it on the news? It was like the bad time in real estate. And you know, all those people that are involved in your real estate transaction, attorneys, lenders, appraisers, home inspectors, surveyors, everybody involved was feeling it. If they ever do, what is it? Vice TV does like the darker side of wrestling and the darker side of the 90s. If they ever did the darker side of real estate, it would be about the housing market crash. It was tough. There are a cajillion theories out there about what went wrong in the housing market crash. We're not going to talk about all those, but one of the more common theories about the housing market crash was fraudulent lending practices. Now, not all lenders are fraudulent, never were not back then, and are not now. You always have bad eggs. Every industry got a bad egg or two. And in real estate, one of the theories of the housing market crash was that those bad egg lenders, they weren't all to blame. It wasn't entirely to blame, but the theory is fraudulent lending practices played a pretty big role in the housing market crash. So as a result of that, laws were created, updated, adjusted. Please understand, real estate is a market. You're always going to have highs and lows. That pendulum is always going to swing. It's a market, like the car market, the clothing market, everything is a market. However, from the housing market crash, we got some laws and rules in place to prevent the lows from being that low again. We're going to have lows, but fingers crossed, you guys, we never see what we saw back in 07, 08, 09 into 2010. So something called the Dodd-Frank Act was created, and Dodd-Frank put in a couple products to help protect the consumer. So we have a new division of Dodd-Frank called the Consumer Financial Protection Bureau, or the CFPB. Their whole point is to protect the consumer. There was also something put in place in 2015 called TRID. TRID is another lender law. TRID is the acronym of all acronyms. It beats any other acronym. TRID is an acronym for the TILA-RESPA Integrated Disclosure. TILA is an acronym for the Truth in Lending Act. RESPA is an acronym for the Real Estate Settlement Procedures Act. Please understand this. TILA was always around. RESPA was always around. TILA and RESPA are not new. They've been around since I think like the 70s. I mean, they've been around for a long time. But what TRID did was come in and combine them. TRID integrated them. A lot of the forms that TILA used were almost the exact duplicate of RESPA. Consumers were getting confused because they didn't know what they were signing. They're like, didn't I just sign this? Yes, but this is for a different act. This is for a different program. So one of the solutions to help better protect the consumer, so hopefully we don't wind up in another housing market crash, is to help educate the consumer on the 30-year loan that they're committing to. Guys, I'm not kidding when I say this. Prior to the housing market crash, some borrowers were seeing their figures and their numbers for the first time when they were sitting at the settlement table. They had no idea what their monthly payment would be until they were told to sign here and commit to this 30-year loan. Did that just make your heart flutter a little bit? Can you imagine signing that piece of paper? And TRID said, that mess must stop. We've got to disclose. We've got to allow the consumer to see their numbers. We got to give them time to crunch them and make sure that they're okay with them. So they not only agree to the 30-year commitment, but so they also better understand what that 30-year commitment is. So TRID was created 2015. You don't need to know that. TILA and RESPA, again, have always been around. They're integrated now, but they still do two different things. When you guys see TILA, I'd actually like you to see the word lending. TILA tells the consumer the cost to get the loan. What are my out-of-pocket expenses at settlement to get this loan? When you see RESPA, I want you to see the word settlement. RESPA helps educate the consumer about the cost to close. What are all of your closing costs, including those lender costs that we figured out in TILA? So they still do different things, but they integrated, they came together, again, trying to make it better for the consumer. And one simple solution that we can help the consumer is to educate them about their loan product, educate them about that commitment that they're getting ready to make. So we're introducing you to TRID now. We'll talk a little bit more about it in 15. We'll talk more about it in 21. TRID is a lender law, not a real estate agent law, but a lender law. So why do we need to know it? Because we're working with the people that this law applies to. We're working with those borrowers that are protected under TRID. So we need that understanding. So more on this. Now let's talk about the players in the lending game. There's 3 players in the lending game. The first player are the feds. The first player of the lending game is the Federal Reserve System. The feds help regulate all money in the economy. Money coming in, money coming out. The feds put different regulations, different restrictions for lenders. We got to keep money flowing in that economy. And a real estate is a great place to have money flowing in the economy. Again, think about some of the price tags on some of these houses. We're not out buying a t-shirt this afternoon, are we? I mean, there's some good price tags on some of these houses. So real estate is a great way to keep money flowing in the economy. And the Fed helps regulate that money, not just in real estate, but the Federal Reserve helps regulate all the money in our economy. Again, please always understand, markets adjust. You're going to have highs and lows. That's a healthy market. Another role that the feds may do, the feds may lend money to the lenders that you and I originate a loan with. And the lenders that you and I originate a loan with are the players on the primary mortgage market. The players on the primary mortgage market is who you and I go into the bank and say, I want to borrow money to buy a house. This is who you're talking to. Please understand, you guys, lenders don't have an endless supply of money. Lenders have to get money to give you money. It's not like they got some kind of money tree out back where they can go pluck $100,000 bill from it when you want to buy a house. Everybody with me? So the lender has to get that money to give it to you. Do you think the lender has to pay to get that money? Better believe it, because you know one thing that doesn't exist? Free money. So when you want money, you got to pay to get that money, and so does the lender. And one place that our lenders might get money from is from the feds. So they borrow money from the feds. Of course, those expenses get paid down to me and you. That could roll into part of their loan origination fee, some of the other charges. But you and I are paying for that money, interest rates. So our lenders that we are talking to, the ones that originate our loans, are either getting money from the feds or they're selling your loan, our loan, to the third player on the mortgage market, referred to as the secondary mortgage market. So you got the feds, you got the primary, and you got the secondary. If the lender's going to sell your loan, if they're going to service your loan, then they are selling it to a player on the secondary mortgage market. Let's say, for example, that I'm a player on the primary market and I borrowed some money from the feds so I can originate loans. So I can give you money so you can go buy a house. And I have some money. I borrowed some money from the feds and I have some money. And I have enough money to give to you, you, and you, so you can go buy a house. But once I give you all my money to go buy a house, I don't have anything left, do I? So what's one way I can replenish my funds? Is by selling your loan. So now I have more money, and now I can give you, and you a mortgage loan to go buy a house. So why does the lender service your loan? To replenish their funds so they can originate new loans so we can keep money flowing in the economy. Whether or not they're going to buy it from the feds, or they're going to sell it to the secondary mortgage market, or if they're going to keep it in-house and keep you for the next 30 years, is all up to the lenders, the rates, what's money going for these days, the yield. Somebody says, is this where the yield comes in? Absolutely. These are the players on the secondary market that are looking for that high yield, looking for that sellable product. So the whole reason your lender sells, if they choose to sell, again, some keep them in-house, some will service their own loans. But if they choose to sell, one reason is so they can replenish their funds, originate new loans, help keep money in their pocket, and also help keep money flowing in the economy. Think about it if you were a primary lender. And I gave all, let's see, there's 18 of us on the call, count me. So I gave all 18 of you a loan to go buy a house. And I can't originate a new loan because I'm not going to sell your loan. I'm going to service your loan. It's going to take me 30 years to get the money back from all 18 of you, isn't it? It's going to take me a long time because you've agreed to pay me back over a period of 30 years. Do I have the funds to float myself for the next 30 years until you pay me back? Or do I need to sell your loan so I can keep this going? You guys with me? All lenders are different. There is no right way, wrong way to do it. I'm sure there's a lot of terms and what ifs and if this and that and everything else. Somebody's had your sold 3 or 4 times. Somebody else asked, do they have to disclose that before they do it? Yes, that is now covered under RESPA. I cannot speak before TRID, but that's now covered under RESPA, that consumer protection. And we'll see that. I think it's 21. We talk about that. So the feds release money into the economy. The primary market is who you and I talk to when we want to originate a loan. The secondary market is who the primary market can sell our loans to, service our loans to. The players in the secondary market, I know you've at least heard of one of these. You guys ever heard of Fannie? Fannie Mae? Fannie is a player in the secondary market. Fannie is a player that purchases loans from the primary market. Fannie will buy conventional loans. Fannie will buy FHA loans. Fannie will buy VA loans. We're going to talk about all that. Fannie will buy it all. Fannie's the oldest, the most established. Fannie's the hungriest. If it's a loan, Fannie will buy it. A mortgage loan, I should say. If it's a mortgage loan, Fannie will buy it. We also have Ginnie Mae. Ginnie Mae only buys FHA and VA. Ginnie's more particular. Ginnie's more selective. We're going to learn in just 1 minute that our FHA and our VA loans are government-backed loans. Ginnie will only buy government-backed loans. I remember that. Ginnie starts with a G, government starts with a G. So Ginnie will only buy government loans, GG. The other player in the secondary market is Freddie Mac. Freddie's the most particular of them all. Freddie only buys conventional loans. Of these players, who does the primary market sell to? Well, it may depend. How much is Fannie willing to pay me for the loan versus how much is Freddie willing to pay me for the loan? What are the terms? Da, 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 da. These are the options. These are our lenders' buyers. And whether or not they choose to buy, there's certain conditions of the loan that has to be met. We'll talk briefly about that. Questions about the players?
The process of servicing the loan, that doesn't affect the buyer in any way, does it?
Nope.
Because
If
all
your
the,
loan gets serviced, it's an assignment. And
right,
with an assignment, all the terms stay the same. The only thing that changes is the name of one of the parties. So if
okay,
your loan gets serviced, the only thing that's changing is the name of the lender. Your interest rate, your payments, your due date, how much you owe, when you owe, all of that stays the same. Great question. And that's what you do agree to when you take on that 30-year fixed mortgage. If Freddie's not willing to buy it at that rate or those terms, then Freddie's not going to buy it. This is why the lenders, the primary lenders, work so hard to have a sellable product, because they want Freddie to buy it. They want Ginny to buy it. They want Fannie to buy it. But guys, this example I just gave was what, 4 or 5 houses? I mean, think about how many loans are originated a day across the country. I mean, my brain can't even wrap around that. There's a lot of money involved in real estate when you think about the big picture. Okay, so let's take 10. And
Oh,
when
can I
we
ask a
come
quick
back,
question?
yeah, please.
So, say I own a credit union, for instance, and I want to sell some loans, and Frannie Mae's out there gobbling them up and what have you. If they're buying the loans, do they ever sell the loans, or are they just gobbling them?
No, they could turn around and sell them as two.
They do
George
sell
came in
them.
and said his loan has been sold 3 times in 4 years. So people
Okay.
are fighting over George's loan. So it doesn't necessarily end here. You may have, Fannie may buy from Freddie. You may have somebody else, maybe an independent, somebody swoop in and buy them. So it may not necessarily end here. If the primary lender is going to service their loan, it never gets here because it stays in the primary market. It never goes. It's never sold to the secondary.
I didn't
So-
know if like Fannie was like the end all and you never get it back from her,
No.
kind of a thing. Okay.
No, it's what she wants to do with it. And bottom line to Fannie is, can I make more money keeping it myself, or can I make more money selling it? Lenders are investors, and investors care about one thing. And what is that one thing?
Money.
Money, 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 money. So it's all what makes the world go round, isn't it? Apparently. Okay, good questions, you guys. So let's take 10. We come back, we're going to talk about conventional, FHA, and VA. Welcome back. So I am taking attendance. And real quick in your book, I think somewhere about pages 394, 395, it talks about the housing market crash. I think you guys should look that over. I think sometimes studying the past helps us better understand why and where we're here today. So housing market crash, we learned a lot. I'll share with you guys the housing market crash. I wasn't in sales yet. I was still an admin, but we all felt it. I mean, as an admin, we got our hours reduced. I had to go pick up some house cleaning gigs just to pay the bills. I wasn't married yet. So, when you're single and you don't pay the power, then your power bill doesn't get paid, does it? So, we all had to kind of work. It was a challenging time. And I tell you, I was almost always one of the first ones in the office, get it turned on and set up and ready to go. And when I got there each morning, before I even started the coffee, I would walk up and down the halls of the office to see what agent had moved out the night before, what agent had cleaned out their cubicle, cleaned out their office the night before. So when my broker in charge came in, I could pretty much meet him at the door and say, so-and-so's gone. It was tough, y'all. It was tough. It was hard to go to work. It was tough. But for those of us that came out of it, I feel like we came out of it stronger. We came out of it with a better understanding. And we're still standing today. So please hear me when I say highs and lows happen. I think we're going to see some lows after this last seller's market. I think we're going to see short sales and foreclosures again after we get out of this heavy seller's market. But I don't think it's going to be as low as the housing market crash. Fingers crossed. If only I had a crystal ball, but I don't. So that's my thoughts. So the recent financial crisis, talking about all the foreclosures across the country, again, kind of help us understand why we're here today. So let's talk about some of, not all, but some of our mortgage loan products. And one mortgage loan product available to us is the conventional loan. Conventional loans are not backed by a government agency. If a government agency is going to back a loan, they're offering a safety net to the lender. So in other words, if we have government backing, if the borrower defaults, the government's there to catch the lender. Conventional loans don't have that safety net. As a matter of fact, conventional loans don't have any safety net. In conventional loans, the lender bears all the risk. So if you default, the lender has nobody to turn to ask for help. Conventional loans are conforming, well, all loans are conforming or non-conforming. Conforming loans mean there's certain bank requirements or just requirements in general that if they meet, if they conform, then it's a sellable loan on the secondary market. So it's not just any loan can be sold. We're talking about conforming loans that are sold to the secondary market. If they conform, Fannie, Freddie, and Ginnie want them. If they're non-conforming, they don't meet these bank requirements. These are the lenders that are probably keeping them in-house. They're not sellable. And I don't know the requirements. We don't need to know those requirements. We just need to know some loans are conforming, some are non-conforming. Non-conforming loans are staying in-house. They're not sellable. They don't conform. Because the lender bears all the risk, because the lender has no safety net from the government, the lender may, usually does on a conventional loan, charge something referred to as PMI or a private mortgage insurance on any loans when the loan, there it is, when the loan to value ratio is 80% or higher. Remember, the loan to value ratio is the lender's ratio. So if you're asking them for a conventional loan of 80% or higher, they're probably going to charge PMI. This is their safety net. Once that loan gets under the 80% threshold, you're not as risky. You don't owe as much. If you originate a loan at a 65% loan to value ratio, you're probably never going to have PMI. If you originate a loan at 90%, you're going to pay PMI until you get it under 80. It's just additional, it's insurance for the lender. Again, the concern is, what if you default? Let's say, for example, we're buying a $100,000 home. 80,000 or 80% of a $100,000 loan is $80,000. So 80% loan to value ratio means you're getting a loan of $80,000. The question the lender has to ask themselves is, if you stop making the payment, can I sell this home and get my money back? That's all they care about, getting their money back. If you pay them every month as promised, they're fine. If you stop paying them every month as promised, they're going to get their money back. This is the promise you made to them. So you originate this loan, you're at this $80,000. You're right on the threshold here. What about, though, if you're originating a loan and you have $50,000 to bring to the table? Now you're only asking for half of that. You're not as risky to the lender, are you? Because if you buy a $100,000 home, it's safe to say they can sell it for $50,000 and get their money back, or $52,000, whatever cost of the sale, to get their money back. Does this make sense? So they need to make sure. That's their question. When you march in the bank and say, I want to borrow money, the lender's number one question is, can they pay me back? I think sometimes we think about people going into foreclosure, like well into home ownership. But guys, I've talked to lenders before, and there are stories out there where the new homeowner never makes their first mortgage payment. Fun thing about real estate, you don't have to make this stuff up. They never make their payment. So when you march in the bank and say, give me $80,000, the lender has to think, if they never pay me a penny, can I sell their home, cost of sale, and get my money back? Does this kind of make sense? That's their number one priority. And again, as long as you're making your payment every month, you're never hitting that lender's radar. You're on their good side. The problem comes in when you stop making that payment. And that's when they're going, oh my God, they're not paying anymore. I got to get my money. So without government backing, 80% or higher, they have more risk because they have more invested. So let's see another example here. We got the property appraised for 100,000. We got a 90% loan to value ratio, which means we're asking for 90,000, 90% loan to value ratio. And the borrower's going to put down their cute little $10,000. The lender's bringing the rest. So because the borrower's only putting down 10%, because they're only bringing $10,000, the lender is the one bearing this risk. And because they're bearing this risk and they do not have a safety net, they'll probably charge private mortgage insurance until that loan dips below 80%. Questions on conventional loans?
So with the private mortgage insurance,
Mhm.
can the lenders say, since they can make kind of their own rules a little bit with restriction, but can they say, okay, 80% yes, but you're not allowed to get out of your insurance plan until it's at least 50% or lower? Like, can they change that percentage amount?
I guess they could. but that's going to be hard for them to compare with other lenders. Because the borrower is going to say, if I go to Joy and get a loan at 90%, she's going to charge me PMI only until I dip under 80. If I go to Julie and get a loan, she's going to charge me PMI until I get to 50. Which one of our products is more attractive to the borrower?
Got it. Okay.
So I guess they can. I'm not sure if usury laws cover that, but even if they could, they're not going to, because they're trying to be competitive with all the lenders out there. So I'm not really sure if that's set in stone, if they have a wiggle room there or not, but that just tends to be what we know, that 80%.
Makes sense. Okay. Thank you.
And again, the question is, like I said, you dip down to $50,000, you buy a $100,000 home, the home's probably appreciated. So when you bought it at 100,000, but now you're in default at 50 and it might be up to 110, 115. So they know they can sell that house, pay the cost of the sale, the trustee, the foreclosure cost, get their $50,000 back, and then pay all the other lien holders. Remember those lien priority, everybody standing there with their hand out trying to get paid. So conventional loan is not backed by the government. They don't have that safety net. Another loan product is called FHA insured loans. Do not let this name fool you. FHA is insuring the lender in the event of the borrower's default. FHA does not offer insurance. They're not insuring the borrower. FHA insured loans insure the lender. They offer a safety net to the lender. If you fall, I'm here to catch you. The government offers protection. They offer insurance to the lender in the event of the borrower's default. FHA loans, the government's involved now. There may be more hoops. There may be more hurdles. Not everybody is going to get approved for FHA loans. Not all properties are going to be approved for FHA loan. The approval process just got a lot stricter because the government's involved. However, the upside of this for the borrower, FHA loan to value ratios tend to be a lot higher, which means the borrower may not have to bring as much to closing. Do not hold me to this number. But for example, the last time I saw eligible borrowers could get an FHA loan with a loan to value ratio of 96.5%, which means you're bringing how much? We thought your little 10% was cute. What's your 3.5% look like? Again, though, not all people are going to get approved for this. Not all properties are going to qualify. When we get to Unit 17, we're going to talk about the appraisal process. The appraisal process for determining value in FHA loan is a lot stricter. The property's got to be in a better condition. So a higher loan to value ratio for approved borrowers. Great program if you qualify, less you have to bring to the table. Of course, more you got to borrow. FHA loans apply to residential properties 1 to 4 units. You will not get an FHA loan on an apartment building of 5 units or more, for example. One requirement of an FHA loan is owner occupancy. So the owner needs to live there. FHA doesn't have private mortgage insurance because they have a government safety net. Instead, what FHA has is something called mortgage insurance premium, or a MIP. The mortgage insurance premium is a one-time fee charged at settlement. So here's an additional settlement charge, closing cost charge to the borrower from the lender. But guess what? This financing fee, this MIP, could be rolled into the loan. So if you don't have this amount of money, they'll just tack it on to your loan amount if you get approval. Like we said, FHA loans, properties have a higher appraisal process. So the appraiser has to be FHA approved before they can do the process. They know in particular what FHA loans are looking for. FHA loans cannot have a prepayment penalty. We talked about this in our promissory note. Prepayment penalty, say if you pay me off earlier, I'm going to charge you a penalty. FHA loans are not allowed to have prepayment penalty. FHA loans may be assumable. If a loan is assumable, that means the buyer can take over the loan from the seller. The buyer's got to get approval. They got to go through the process. The bank has to sign off on them, but they may be assumable. Question comes in, is this the type of loan you get if you get the down payment assistance? Those down payment assistance vary from city to county to state, and they do vary across various loan types. So if you want an FHA with down payment assistance, just talk to your lender or lenders while you're shopping that product. But the down payment assistance programs that you guys might have heard about are different than these traditional types of loans. If something is assumable, that means the buyer is going to take over the seller's loan. So the seller makes the payment on August 1st. You buy my house on August, what's today? 8th? Does that sound right? Okay. See head bobs? Okay. I make the payment on August 1st. You buy my house on August 8th. You make the payment on September 1st. You just assumed my loan. You just swept in and took over my payment. And yeah, you had to pay me for the difference. So if I have $50,000, you're buying my $100,000 home. You take over my $50,000 mortgage and you pay me $50,000 at settlement. That's how you make the seller whole. Give me money and take over my debt. We're going to talk more. We're getting there. What would be reasons sellers won't want to deal with FHA loans? It may not be that they don't want to deal with FHA loans, but it might be that their property doesn't qualify. So for example, if the home was built prior to 1978 and it's got chipped paint all over, inside and out, the FHA appraisal isn't going to approve that. What do we know about properties built prior to 1978? There's a good chance they have what in them? Lead. And you got chipped paint laying around where kids and dogs can come up and lick it and touch it and everything. You may not get loan approval. Another example, if you're wanting to get an FHA loan and the property's roof is like 40 years old, it may not get approval under that FHA. So it's not that the seller may not want to work with an FHA. It just might be that the property isn't going to get approved. When you start working with buyers, make a note. Please do not do it now. Make a note. When you start working with buyers, you can go to FHA's website, and within their website, it gives you a list of things that probably aren't going to get approved. So when you're working with that FHA buyer, another reason why I tell you not to do it now is because that list changes. So when you start working with this FHA buyer 6 months from now, go get that list. Because as you and buyer are walking through the home, you can say, this, and this may be the reason why we don't get approval. Nothing to do with the person. It's the property. A lot more hoops and hurdles to jump through now that the government's involved. Not trying to say anything bad about the government. It is what it is. So FHA loan, it insures the lender. It offers the lender a safety net. Another loan product is our VA guaranteed loan. The VA is not guaranteeing a loan amount. The VA is not guaranteeing the people. The VA is guaranteeing the lender in the event of the borrower's default. VA loans are set aside for our veterans. Not all veterans are eligible for VA loans. They still have to go through the loan approval process. Just because you're a vet is no guarantee you're going to get a loan. This is a great program for eligible veterans and their unremarried widows and widowers. This also applies to 1 to 4 unit property loans or properties. Again, you're not going to get a VA loan for a apartment complex of 6 units. VA does require owner occupancy. And one of the biggest draws, one of the biggest attractions for veterans to get the VA loan, eligible veterans may be entitled to a loan to value ratio of 100%, meaning what's your down payment?
Could you go back to the last slide for just a second?
Guys, remember my PowerPoints are in the online learning system. And we're
Thank you.
also recording, of course. So anyway, 100% financing available, meaning if they qualify, they can get in a home with 0% down. Is that huge for our veterans? That's huge. Another big perk, they do charge a funding fee. The lender still has to make money to fund the loan. But guess what? That funding fee can be rolled into your financing. So it might be that your loan isn't 100%. It might be that it's 105%. I got to be the buyer's agent of a vet once. She qualified under all this funding fee and everything. All her closing costs, down payment. Y'all want to know the amount on her closing disclosure that she had to bring to settlement to buy a house? Anybody want to know how much she had to pay? How much she had to bring the day of closing? That's right, a big fat 0. Because she qualified, she approved, all of her closing costs could be financed. And the day of settlement, she didn't have to go to the bank to get money. It's probably one of the more prouder moments I ever was in my real estate career. That was a great day. And I was so happy for my buyer, for my vet buyer. Each vet gets what's referred to as a certificate of eligibility. The certificate of eligibility tells them what they're eligible to borrow. The certificate of eligibility tells the vet how much VA funds they can get to buy a home. Vets can only get or have one certificate of eligibility at a time. So if you max that out, you're not going to be able to get another loan until you pay that off. So you can't get a certificate of eligibility, buy another house, buy another, get another, da, da, da. You get one certificate of eligibility at a time. Once you pay off that loan, you can apply for another certificate of eligibility. The other thing about VA loans is also the appraisal process. Again, the government's involved. So the home has to appraise, has to be approved. Same conditions, can't have chip paint prior to 1978. Probably frowned upon a 40-year-old roof. I mean, think about it. If you got 105% financing, 40-year-old roof means what? You're going to have to probably buy a roof again soon. And the lender's going, whoa, 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 whoa. You have 105% financing for me? Can you afford to put a new roof on the house soon? So that may be why that 40-year-old roof doesn't get approval. So the appraisal process is referred to as a certificate of reasonable value. And that tells the lender how much they can lend this vet for this property. VA loans are also assumable, but check this out. A VA loan can be assumed by anyone. You don't have to be a vet to assume a VA loan. But remember, the vet only gets one certificate of eligibility at a time. So if they allow their loan to be assumed and the new owner takes it over, that certificate of eligibility is still out there. It doesn't go away when the loan is assumed. Once you get that paid off, once you pay off that loan, you restore your entitlement. And again, you may apply for another certificate of eligibility. And once again, VA loans cannot charge a prepayment penalty. FHA and VA loans cannot charge a prepayment penalty. Conventional loans on $150,000 or less cannot charge a prepayment penalty. So really, if we're dealing with prepayment penalties, possibly is conventional 150,000 or more. And again, it's up to the lender and the loan product. We're not seeing as many prepayment penalties anymore, but they are still out there. Questions on our VA loan?
So you said like for the certificate of eligibility, you can only have one while you have a loan that you're paying back. Is that what you're saying?
That's right. Once you get your balance down to zero, you have a restoration of entitlement and you can apply for another certificate of eligibility.
Which the certificate of eligibility allows you to be eligible for a loan, right? Is that what
The certificate of eligibility tells you the amount. So
Okay,
maybe you
okay,
max
okay.
it out, maybe you don't, right? You're
okay.
entitled to X amount.
Got it.
Yep. VA or vets that purchase their primary home using a VA loan are more than likely, because of that amount, they're more than likely to purchase their second home, their beach condo, using FHA or conventional. Because remember, VA says too, it's got to be owner occupied. So there's the second piece of it. Can you get this loan if you had been married to a vet before? VA guaranteed loan programs are eligible for eligible vets and they're unremarried widows and widowers. So if you get a divorce, you don't qualify. Unfortunately, you have to lose your spouse in order to qualify. I think that's the better part of the program. I mean, it's a great program for vets, but it also helps their unremarried widow and widowers. Another loan product that is available for eligible people is a USDA loan. What do you guys think of when you think of USDA? Yep. Tim, you're my kind of people. I was just going to say, you think of a big juicy steak, you are my kind of people. With USDA, we think of rural, we think of agricultural. So what type of loan is this for? This is for rural areas, possibly for the family farms. You are not going to get a USDA loan in downtown. USDA loans are set aside for rural areas and family farms. USDA loans are administered by the Rural Housing Services, the U.S. Department of Agriculture, for your source. This could guarantee or originate or assist single family, again, in rural areas. To be eligible for a USDA loan, you got to be in a rural area. You have to prove that your family otherwise would not be in safe, decent housing, and you have no other financing available. These loans tend to gravitate more towards low income families in a rural area or the farm. One draw for USDA loans, again, low income families in rural areas. One draw for these low income families with the USDA loan is they may be approved for longer than normal repayment periods. So you get a home loan and instead of for 30 years, you get the loan for 33. You still owe the same amount, same interest rate, same. But if you can stretch it out for 33 or 35 years, your monthly payment gets a lot smaller because now we have more months to pay. The figures are still the same. We can just stretch out those payments and have a lower than normal repayment amount repayment figure. So you might be eligible for that. Those that qualify may see a low to no down payment, 0 down payment. And then USDA loans may be also to subsidize the interest rates, or interest isn't going to accrue right away. Think about your student loans. Interest doesn't accrue, it's subsidized until you get that piece of paper in your hand. And then it's time to start paying, isn't it? College loans. Goodness. When you start working with buyers that are interested in going after a USDA loan, one thing you can do is go to the USDA's website and they offer you a map. And when the buyer says, I want to see a property, you can go to the USDA's website and make sure the property is in that rural area. Make sure the property doesn't fall. You guys see the yellow here? The yellow is not eligible for a USDA loan. This is downtown Winston-Salem. Because of the population, it's not rural, but it will show you, see up here in Tobaccoville, and here's Ballew's Creek. Y'all check out Rural Hall. Rural Hall isn't as rural as it used to be, is it? Rural Hall's gotten really big. Y'all got a Walmart up there now? I mean, my gosh. Laurel Hall, for the most part, is no longer going to qualify for USDA. So again, as populations change, so does the USDA map. So does the USDA eligibility map. Is it King that has the Walmart? Okay, I was close. I'm getting my rural areas. That's right. That's right. Right off of 52 there. I go up in that area, right? King, Rural Hall. I'm like, where did all these people come from? You know where they came from? They came from Winston-Salem. They said, I'm going to head north. And they went up 52 and they got that far and stopped. So a family that doesn't meet the requirements of rural would still be subject to specific lender rules or loans, even if they're not in a rural. So if they don't meet the requirements of rural, then they're not going to be eligible for a USDA. So now we just need to talk if we can get them conventional, FHA, right? There's other loan products out there. But if you're not in a rural area, you're not eligible for this product. Another loan type, loan option, I should say, is called a purchase money mortgage. Purchase money mortgage is seller financing. Purchase money mortgage is seller financing. Purchase money mortgage is seller financing. Way too easy to say seller financing on your test. What might they say on your test? Purchase money mortgage. With seller financing, the seller's acting as the lending institution. We're not going through a bank. We're not going through a lender. Instead, the buyer and the seller are going to sit down and agree to the terms. You're going to pay me back X amount a month with this interest rate. Better believe the seller's going to collect interest. And it's going to be for a term of this long, this amount per month. Buyer and seller are coming to terms. When the buyer buys, they're not paying a bank. They're paying the former owner. Remember back in Unit 10, we talked about installment land contracts. Installment land contracts is also a type of seller financing. Remember, in an installment land contract, the buyer's paying the seller, but they're not doing it one lump sum. They're paying in installments. The difference between an installment land contract and purchase money mortgage is when the deed changes hands. In a purchase money mortgage, the deed changes hands at closing. In an installment contract, the deed changes hands when the last payment is made. when the last installment payment is made.
So that means the buyer would have equitable and legal title with the purchase money mortgage, but with the installment, they would only have equitable title until
You got it? Yep,
payment.
until they make that last payment. Yep. Yep. Which one is better? Well, it depends on the buyer, depends on the seller, depends on the terms. I
So
still see this, yeah.
why or how can you deliver the title at closing when it hasn't been paid?
Well, it's the same thing as borrowing money from a lender, right?
Well, I
I
don't have
still
the
owe you
title
money.
to
I'm
my
sorry?
house or my car until it's paid for. So who holds it?
The lender, the seller in this case, or the owner. Because remember, title is just the idea. Deed is the documentary proof. So the new owner is going to have the deed in this case. That's what's going to be delivered at closing. But they have this agreement through the seller financing. Instead of paying Wells Fargo, I'm going to pay the seller. And that's
Correct.
their agreement.
I guess I'm just confused on the verbiage.
Which is
I
that?
think I'm kind of confused too. So is it the title or the deed that's
Title and
delivered?
deed are the same thing.
Okay,
Title is the idea.
right.
Deed is the documentary evidence.
But in this case, you just get it at closing instead of when you're done paying.
That's right. That's the only difference between purchase money mortgage and the installment land contract is when the deed or title changes hands. We still see seller financing available. I'll tell you where I see it the most often. Not typically in real estate transactions, but every once in a while, I'll drive by land, and there'll be a big sign on the corner of the edge that says 40 acres plus or minus, seller financing available. So you got a bunch of land to sell. It might be an option you're willing to consider. I would talk to your accountant. We'd want to make sure the buyer can afford to pay. We're still going through approval process. I'm not just pulling anybody off the street and saying, hey, you want me to finance you? Other loan types. Starting on page 403, we don't need to be as specific with these, but we do need a basic understanding of what these other loan types do. So first off, we have something referred to as a package loan. A package loan combines the purchase of real property and personal property. It packages them together. It's not uncommon, for example, for beach condos to come furnished. Do you just picture a bunch of wicker? I always picture wicker for some reason. So if you're going to buy it, or when we buy a beach condo, if you buy it furnished, we might do so using a package loan. I'm buying the condo and the wicker furniture that comes with it. Bridge loans are exactly what they sound. They're short-term loans, maybe even a couple days. Bridge loans are meant to fill the gap from one loan ending and another loan beginning. It's a short-term gap in between loans. It bridges the loans. A blanket mortgage covers more than one piece of land. So if you're going to buy multiple parcels, you could do so using a blanket mortgage. For this, think about the developer that's going to buy 5 pieces of land to develop them, subdivide them, build on them. and turn around and sell the homes. If you're buying more than one parcel, a blanket mortgage might be an option for you. An open-end mortgage is like a line of credit borrowing against your property. If you have unexpected debt come up, maybe major medical bills or something, you may want to consider an open-end mortgage borrowing against what you already have, the equity you already have in your home, to help pay down those bills. Construction loans are financing new construction for improvements, possibly. If you apply, yep, you'll borrow against your home to update the bathroom and the kitchen. Construction loans are to finance new construction. Construction loans get tricky because the borrower is asking for money for a property that doesn't exist yet. We're still standing on a hunk of dirt with a dream and a vision saying, give me money. These sound pretty risky to the lender. Some lenders with construction loans will issue the loan amount in installments. So they may say, I'll give you X amount of money. When the house gets to the framing stage, we're going to send our inspector out there and make sure everything's going okay. And upon approval, we'll issue the next installment of the loan. So instead of giving it all at once, they're going to issue it in installments based on the progress of the property being built. Buy down loans are a way you offset your interest rates. So you could buy down that interest rate, lower your initial interest rate. Yeah.
So with the construction loans, how, so you said, I think I heard you correctly when you said they're not just for new construction, you can also get a construction.
No, it's got to be for new construction. You're not going to get a construction loan for something that already exists. You're froze.
Could you do the construction loan if you're fixing up a house? Like if you were doing renovations and everything?
I
Would it be
always
possible to do a
understood it's
construction
to
loan,
build.
say,
It's annoying. Okay.
I'm sorry? We got some hiccups. Yeah, I've always heard it's to finance new construction. If you want to do upgrades or improvements, you may want to, I mean, you can always ask, you might find a lender that can do that. But you may be looking at, another type of loan, but for construction loans, for our purposes, let's just think new construction.
I'm sorry, I did not hear a single thing you said. My internet went out, so I just got back in here.
New
But I heard-
construction loans are typically for new construction.
Typically for new construction. Okay.
Building brand new. Okay, improvements, book says improvements, so new construction and improvements.
I have a question really quick. So with the type of loans that people get and the things that go into that, would that ever affect the appraisal or what people can get a loan on in the future? Say if they were to sell it or anything like that, say if it was a Section 8 house that somebody had, then they sold it off, would anything like that cross over into the future, or would it just kind of be a fresh slate?
I'm going to say, could it affect? Yes, it could. How could it affect? Not really sure about that, but could it? Yes. Again, it depends on the loan product and the specifics of each loan. Home equity loans are also borrowing against your home, borrowing against the equity that you have in the home. Pretty much the big difference in a home equity loan and an open-end mortgage. Home equity loans are generally used to pay back, like we talked about, those medical bills, maybe large unexpected expenses. Both home equity and open-ended are borrowing against the property, just maybe for different things. And then the reverse mortgage is exactly how it sounds. Instead of you paying the lender pays you. If you're eligible for a reverse mortgage, you have equity in your home. You almost have this thing paid off. And instead of you making payments, the lender's sending you money. They're paying down your equity. Reverse mortgages could be good programs for seniors, elderly people, those that need a little bit extra money to help supplement their Social Security, Medicare, if they need additional income. So they have choices. They could either sell their house and get all their money, or they could apply for a reverse mortgage and start receiving some of that equity back in smaller payments. I've been seeing last couple years, makes you feel old. Tom Selleck, have you guys seen these commercials? He's kind of been the spokesman for reverse mortgages lately. You see his commercials. Again, the lender's sending you money. They're sending you your equity in payments. Guys, please remember, these are all green stars. We're not spending all our study time on these. We're just having a basic understanding of what these do. If you see a test question on these, it's going to be something like where it gives you a little scenario and what loan product would be your best bet. Questions? Okay. Let's take our last break. Come back. We keep going in 15.
Yes.
come back. I say last hour, but that's not even accurate, is it? Less than 1 hour. We move right along. So I am taking attendance. And the other thing to keep in mind about all these loan products and everything we're talking about this in the unit, we're not here to try to take the lender's job, because ultimately we always want to send our borrowers to the lender. So we're just getting that general understanding. So when your borrower comes to you and says, I want to buy a furnished condo, is there a type of loan I can get? You know enough to say, you might be eligible for a package loan. Let's call your lender and see. You guys with me? I'm not taking the job of the lender. We're not teaching you guys to take the job of the lender. I sometimes fear in pre-licensing, I'm teaching you guys just enough to be dangerous. I'm giving you so much knowledge you think you can, but remember guys, we always need to stay in our lane and act our role. And our role is that of a broker, real estate broker. So just a general understanding so we can assist our borrowers. Did I take attendance? I did. Okay. You guys see a flash on your end? Short-term memory. Okay. Thank you. And I have taken attendance, so make sure you tell me you're back if you missed the flash. Thank you. We talked about mortgage priorities. Mortgage priorities, we know they're paid in the order in which they're recorded. North Carolina, we're a pure race state. So who's going to get paid? The first one to get to the courthouse. Your senior mortgage is the loan that you originate to purchase the home. Your senior mortgage is your number one mortgage. If you borrow more money, if you apply for a different loan, you may have other mortgages. Those are referred to as your junior mortgage. So your senior is your first one. Your juniors are all others after that. And there's something called a subordination agreement. Better safe than sorry, right? Something called a subordination agreement. Subordination, if you subordinate, it's the act of placing yourself in a lower ranking. So when would a subordination agreement kick in? Let's say this is your timeline. When you bought the home, you originated your senior loan. And somewhere 10 years, 15 years down home ownership, for whatever reason, you need a second loan on your property. So you get a junior mortgage, you get another loan on your home. Now we have two mortgages, right? We have a senior mortgage and a junior mortgage. Lien priority says who's going to get paid first. Your senior mortgage, because they recorded first, because they recorded back in the day when you bought. Everybody good with me so far? So if you get that junior and you foreclose, the senior mortgage is standing there with their hand out. What if you decide one day you want to refinance your senior mortgage? If you refinance your senior mortgage, they're going to redo it. They're going to recrunch the numbers that are out there. And then they're going to have to come back and record that new refinance loan. Now, who's getting paid first? Your junior mortgage. Guess what? The senior mortgage is not going to agree to refinance if the junior mortgage doesn't agree to subordinate. So in order for the senior to refinance, the junior has to agree. I'll still let you get paid first. And that's what we mean by subordination agreement. Somebody's got to place themselves in a lower ranking. And in this case, it's the junior. If the junior says, no, you refinance, I'm getting paid first. Guess what? You're not going to get approval for that refinancing. So subordination agreement, the act of placing yourself in a lower ranking, a lower position. All right, page 405, we're going to get into more talking about the lending practices and procedures. Again, kind of some of the ideas of the lending, so we have that basic understanding. The loan application, the lender is gathering all sorts of information with the loan application. And the loan application is going to include information about the borrower, the individual or the people's income, the expenses that they already have, what debt do they already have coming into this loan application. The loan application also considers information about the property. Again, as we just learned, some loan products have to have the property appraisal approved. So if the property doesn't qualify, and then we have the loan application is going to include information about the loan itself. I think the loan process is not a part that we're involved in, but it's a part that we can kind of help the lender by having conversations with our borrowers to make sure they don't lose any eligibility. So for example, I think one thing that we can really do in the transaction, one way that we can really help is to look at our borrowers and tell them, once you start this loan application process, I don't need you running out there and opening new accounts, creating new debt. I took a financing class once, and it was really interesting about this. And it was really interesting. And the way the lender explained it to us, think about when you start this loan application process, the lender takes like a snapshot of your debt and income. What's your picture today? Fast forward to closing, where they're just about to issue you the money. They're going to take another snapshot of your finances. If the snapshots don't match, we got an issue. So once you start the loan application, don't do anything. I mean, you can go to dinner tonight, right? But don't mess with your financing. Don't mess with your debits or credit, because if those snapshots don't match, the lender pretty much has to start over. And now we got a delay in closing. So as the buyer's agents, one thing we can do to help in the transaction is have a conversation with our buyers. Guys, there have been cases, I know of agents personally, that buyers go under contract and they get so excited and they run out and buy a daggum car for the new garage that they don't own yet. Guess what? We're not getting loan approval. You're never getting that car there, or that home, that garage, I should say. You're never getting that garage. There have been cases, buyers are excited when they go under contract and you sign the contract and they say, yeah, you're going to close in 45 days. And they hop in the car and they run out to Rooms To Go and finance living room furniture, dining room furniture, bedroom furnitures. Guess what? You don't have a house to put all that furniture in. So one of the best things we can do to help our buyers is to tell them not to open new accounts, not to make major purchases, not to do anything to make their snapshot from loan application to closing to make that snapshot change. Wait until after closing to buy the car and go to Rooms To Go and all those other things that you want to do for your new home. True stories. Have these conversations with your buyers. Another thing lenders are going to take into consideration is the applicant's credit score. Credit scores generally range from 300 to 850. The higher your score, the lower risk you are to the lender. The higher your credit score, if you have a credit score of 800, for example, what are you telling the lender? I make all my payments on time, every time. Does a lender like to see that? Yes. If you have a credit score of 400, what are you telling the lender? I don't pay anything. So your credit score, it's not the end all be all, but it's a jump start. Again, all lenders are different. I've heard some lenders say if your credit score is below 560, fix it and then come talk to me. I've heard other lenders say 650 is their minimum, right? Just for examples. So all lenders have a different tolerance. If you go to a lender and your credit score is under their tolerance, you're not going to get far in the loan application yet. But I tell you what, a good lender is going to talk to you about how you can get that credit score up so you can be eligible to borrow a home. I mean, how do you get the credit score up? Pay down your debt, right? Start making the payments on time. I mean, there's things that we can do. And a good lender is going to help that borrower, because once that credit score comes up and now they're eligible, the lender wants the borrower to call them. So if you're the one that helped them get out of this, you're more likely to call them. As their potential agent, stay in touch with them, because when they are ready to buy, who do you want them to call? You want them to call you. So put them on your mailing list, call them every once in a while, reach out to them periodically and ask them how they're doing so you can stay in front of it. So a couple months or maybe a year or two from now, when that credit score comes back up and they're ready to look at this again, they're calling you. So credit scores is just part of it. Another part of it is the credit history. The underwriter is the one from the lender that's going to process the loan. The underwriter is the one that crunches all the numbers. The underwriter doesn't leave many rocks unturned post-housing market crash. Anybody buy a house in the last 12, 13 years? Do you feel like your lender was getting awfully personal with you? There wasn't much. There weren't many pennies in your financing that the lender didn't know about, right? That's the underwriter's job. They're getting all up in your financial business, trying to make sure that you're eligible to purchase this loan. So the underwriter is going to look at your credit history. They're going to want to see 2 years in detail. If you have inconsistencies, if you don't have regular income, for example, or maybe you had a gap where you were unemployed, for example, they may ask to go back further than 2 years. But they're going to start usually with 2 years, may require more. They're going to look at your last 7 years of your repayment history, making sure that you can make those payments. If you have some gaps or some lapse in your credit history, the underwriter may make an exception if you can show maybe reasons of divorce, death of a spouse, maybe medical issues. If you can prove why you have that gap, they may, please note that word may, make exceptions and be willing to work with you. But again, they may just have to go back further and study your credit history. If you have a low credit score and you have a poor credit history, you're probably not going to be eligible for FHA or VA loans. Because remember, now the government's involved, more hoops and hurdles. The government's not going to offer to protect the lender if you don't come into this with a good history. So your other option might be conventional or get that credit score up. I just mentioned about some people have gaps or inconsistencies in income. Y'all want to hear something ironic? Do we like ironic things? Y'all want to hear something ironic? Real estate agents, we may have to jump through more hurdles to get a mortgage loan because I don't get paid every other week. I don't have consistent income. It might be that I have 6 closings this month, but I don't see another closing for the next 3 or 4 months. I did not just say that real estate agents could not get a mortgage loan. I just said we don't have consistent income and we may have to show more than 2 years detail. Isn't that ironic? The very thing I do for a living, I may have to jump through an extra hurdle or jump through an extra hoop. Isn't that something? But again, I don't get paid every other week. So 2 years may not be enough. I may need to prove further back in my credit history. At some point in the loan application process, the lender is going to lock in the rate. Remember, when we see rate, we're referring to the interest rate. So at some point before the loan is originated, the interest rate needs to get locked in. And once that interest rate is locked in, that is your interest rate for the life of your loan. If we lock it in at 4.5% today, and the interest rate changes to 4% tomorrow, you're already locked in at 4.5%. But guess what? If we lock it in at 4.5 today and tomorrow it goes up to 5%, you're already locked in at 4.5%. So once you're locked in, that is your interest rate for the life of the loan, the term of the loan. Let's talk a little bit about what all this means for us. Lender hat off for a minute. Let's put our broker hat back on for just a second. As we've been saying, we need a basic understanding of how lenders decide whether or not to approve buyers. I'm not approving, I'm not pre-qualifying, I'm not pre-approving, but I have this basic understanding. Some of the math that we're going to do on Thursday is pre-qualifying buyers. We're going to look at if your buyer wants to see, brand new buyer wants to see a property this afternoon or Sunday afternoon, and you can't get a hold of the lender, you may want to crunch some numbers just to make sure that you have an idea if they can afford it or not before you hop in your car and go out and show them that property. No, and we'll get in touch with the lender for the real deal Monday morning. So having that idea so we can assist. The beginning of the approval process, the lender may issue a pre-qualification or they may issue a pre-approval. So let's talk briefly about the difference between the two. With the pre-qualification is the first step in the process. And the pre-qualification, the borrower contacts the lender and says, this is my income, these are my monthly expenses. And based on the information provided by the borrower, the lender will issue a pre-qualification. They're not verifying it, they're not checking it. They're just saying, based on what you told me, this is what you're pre-qualified for. So if you lie, is this what you're going to be pre-qualified for? No. Well, it'll be what you pre-qualified for, but it's not going to be what you get. So they're not verifying it pre-qualification. They're just crunching the numbers that the borrower submits. The next step is the pre-approval. Now the lender is crunching the numbers. Now the lender is verifying that you told the truth. To the seller, a pre-approval looks a lot better than a pre-qualification. However, some lenders may not offer a pre-approval until we're under contract. So we can only get under contract with a pre-qualification and then start the pre-approval process. Understand, there's only so far in the loan process we can go until we get a property. So we can get the people pre-qualified or pre-approved, but we can't go any further until we know that this buyer is under contract to buy 123 Main Street. We don't get final loan approval until days, maybe a week, usually before settlement. The lending process is the longest part of the contract to closing process because it takes the longest to get that that approval. And again, it doesn't rarely come, very rarely does it come anything before near the end. Talking more about that process when we get into Unit 21. Is this what happened in 08? I'll tell you, part of what happened in 08, yeah, they weren't verifying. They're saying, all right, well, Tim says he makes X amount and da-da-da-da-da. So based on what Tim says, here's a loan. They were kind of, prior to the housing market crash, I mean, it's like they were giving loans away. It was kind of like Oprah, right? You get a loan, everybody gets a loan. It was a good time. But guess what? Not all those people were getting loans may have been approved. They were just throwing money out, and then they couldn't wonder why people couldn't pay it back. I don't understand. So part of it, that fraudulent lending practice, This is why things have tightened up. This is why things have cracked down a little bit. Yes, ma'am.
So the pre-qualification is kind of like a guesstimate, and then the pre-approval is like, the pre-approval is a, not necessarily a guarantee, but a more solidified.
Neither
estimate.
one, you're right, neither one are guarantees. Again, the difference is the pre-qualification, you're right, it's just a guesstimate. I gave you numbers, and based on what I provided, you're gonna tell me what I'm pre-qualified for. Pre-approval, now the lenders put their eyes on it. They've picked up the calculator. They've done your credit history. They've, verified those numbers. They've asked to see your check stubs, if you will, for your income, to verify your income, that kind of thing. So they've put their hands on it now with the pre-approval. Again, though, we can't go any further through the approval process. We can get the people pre-approved, but that's as far as we can go until they decide on the property, until they have a contract. And that's when the loan application, the official piece starts. I'm going to go back for 1 second, because the loan application includes the people and the property and the loan information. So there's only so far we can go when we just have the people. And that's why, again, that's why it takes so long, because we can't go any further until we get a contract. And that's when the big work starts. At the end of the loan, once the lender collects everything from the loan application, we got the property, we got the people, and now the lenders really start to crunch the numbers. That's when they're sending it to underwriting. Underwriting doesn't see it until we have the property, until we're under contract. That's exactly right. Housing market crash it was tough, you guys. I hope your experience with something like that is based on what I've told you today. Never want to see that again, and I really don't think we will. So underwriting's the one that crunches all the numbers. They're the ones that they don't leave any rock unturned. Those of you that have bought a house in the last 12 years, I had buyers look at me once and say, you develop a very intimate relationship with your lender, don't you? And I said, yeah, they know more about you than most, right? They're trying to prevent this housing market crash idea to happen again. We're trying to make, somebody says you're have somebody that makes $12.75 an hour and they bought a $275,000 home. I'm not a lender. I don't have a calculator in front of me, but I'm telling you, those numbers don't work out. And that's what underwriting is trying to prevent. If you're buying a $275,000 home, can you afford to make the payments for the next 30 years? So they're crunching, they're digging deep to learn about as much as your income. If you have longevity of your job, if you job hop, they may need to go back further than 2 years. If you don't have consistency in income, like you're an independent contractor. Is it acceptable income? Another theory from the housing market crash was illegal money. Think the mob, drug money. Yeah, I'm serious. Y'all are laughing. I am dead serious. And now today, cash is, it's still king as long as you can verify where it came from. If you just show up with cash, the lender's got to source it and make sure it's a legal source and you're not involved in anything fraudulent or shady. So in a sense, cash isn't king anymore. Cash is only king if you can source it, legally source it. These are all things that underwriting is looking at. Long gone the days of being able to show up at closing with a big bag of cash. Here you go. They want to know, where did that come from? How did you get that? There's several financial experts out there, for example, that say, if you want to buy a house, start saving now. And one way to save is every time you get paid, you take $20 and you put it in an envelope. And once that envelope fills up, you have your down payment for, the car, the house, or whatever. That's fine and dandy, except when you pull that envelope of cash out to the lender, you can't source it. Where did you get the cash? So money in the bank, that's what the lender can source. This is everything that the lender's looking for to get that approval process. Once we get all the information, or the lender gets all the information from the loan application, they send the loan through the first round of underwriting. It's not uncommon for a loan to come out of the first round of underwriting requesting more information. Maybe they need to see another year of credit history or something else on your income. It's not uncommon for it to come out of underwriting requesting more information. The borrower provides the requested information. It goes through a second round of underwriting. And from there, fingers crossed, we get loan approval or denial. Very rare do we have loan approval while we are still in due diligence. Remember what I just said? Loan approval comes sometimes a couple days, 3-5 days before settlement. We're out of due diligence. We're days away from settlement. So what we strive to do during due diligence is get everything for the loan application, the appraisal, all those pieces, get it through the first round of underwriting. Because when it comes out of the first round of underwriting, the lender has a pretty good idea if you'll get approval or not. Everything's looking good. I just need these 3 documents from you so we can send it back through underwriting and get that final approval. Or it's coming out of underwriting, and I'm telling you right now, things aren't looking good. That's what the buyer has to consider when they're deciding if they want to terminate during due diligence and get their earnest money back, or continue through and buy and risk that final loan approval. There are risks involved with buying a house. It's a house, and there are risks involved, and the loan process is part of that risk. So again, what we strive for during underwriting or after the first round of underwriting is that pretty good idea from the lender, no guarantee. Let's see, why would it matter if you were paying with cash in full? Now, if you're paying cash in full, the lender's not involved, right? So if you're paying cash in full, this isn't even a conversation. Now it's up to the attorney how they want you. And then again, the attorney's not going to let you bring a big bag of cash. You're still going to have to show up with a cashier's check or money order. But yeah, if you're a cash buyer, 100% cash, there's no lender involved. TRID's not around, Consumer Financial, none of that stuff is around because the lender's not around. Yes, ma'am.
Is there any, so like, I know that there's some mortgage lenders that will actually give you the pre-approval first rather than the pre-qualification, so that way they already go through the majority of the approval process in lending before you even go look at houses, potentially, just in a random scenario. Is it possible for the lender to have kind of like a penalty if, let's say, for whatever reason, once you go under contract, closing is in 15 or 20 days, and you have your due diligence period, and during that period you exercise your right to terminate for any reason, no reason at all? Is the lender allowed, and they've already approved you and everything with the loan is good, and you pull out of that contract, is the lender allowed to I guess punish you for that?
What, for not closing?
Yeah, for not closing.
Not that I've ever heard of. Again,
Okay.
that's a good way to get a bad reputation, and people are going to hesitate to use you, because what you're saying is, I'm going to try to get a loan, but if I don't get approval, if I decide not to buy this house, I still have to pay you. So could they? Well, sure, of course they could. Are they in the practice of doing that?
Probably
Not that I'm aware of.
Okay.
I always think of underwriting as a big black hole somewhere, just kind of sucking in everything. Because when you call the lender for the update on your borrower's loan, on your buyer's loan, and you say, hey, just calling to check in and see how things are going, the lender's going to say, It's in underwriting. And I think, where is that? Where can I find it? Can I go visit it? So underwriting, some lenders, again, in-house right there in the office, others of them outsource it. I mean, I know there's a huge underwriting service like up in New York City, so underwriting is just where the people are sitting there crunching the numbers, pulling all of your debt income, pulling all those numbers. And that's who the lender communicates with for the updates on your loan application, for updates on your loan approval. We mentioned qualifying a buyer. When we come together on Thursday and we do that math of qualifying a buyer, we're going to talk about some qualifying ratios. I'm just going to put these here for now. We will talk about what these numbers mean on Thursday when we pick our calculators up. Qualifying ratios. In order to qualify, for example, conventional loan, there are two ratios that the borrower has to be approved under, and they're looking at two different things. So they're looking to get you approved under the 28% ratio. They're also looking to get you approved under the 36% ratio. So this is the math that we have to look forward to. FHA has different ratios. VA only has one ratio because VA just looks at total debt to income. They don't look at conventional and FHA kind of break it down to different types of debt or income. So again, we'll break specifically the conventional loans ratios is what you can expect to see on your exams. So when we come together on Thursday, we'll pick the calculator up and we'll learn how we can pre-qualify our buyers for a conventional loan using the 28 and 36% ratios. Another lender law, something else that lenders have to do abide by, is that T in TRID. We're going to talk a little bit more about TILA. TILA stands for the Truth in Lending Act. Remember, this tells the borrower, the consumer, the cost to obtain the loan. How much is it going to cost me to get the loan? TILA is also referred to as Regulation Z. I would know that. TILA is also referred to as Regulation Z. TILA is a lender law administered by the Consumer Financial Protection Bureau. Other than informing the consumer, educating the consumer on the cost to get the loans, another thing that TILA does is to put advertising restrictions on the lenders. It cautions the lenders about advertising specifics about the loan product. Understand this. Loans are not a one-size-fits-all package. If we really wanted to have a lot of fun this afternoon, when we got off this call, every single one of us could call the same lender and get pre-qualified for the exact same amount. And guess what? Because of the differences of our income, our expenses, our credit history, and our credit scores, we would all walk away with different terms. Some of us would have higher interest rates than others. Some of us would have more down payment to put down, meaning we would have a less of a monthly payment. So that's what I mean. Mortgage loans are not a one-size-fits-all product. So the lender is restricted from advertising interest rates, repayment plans, repayment programs, because the thinking here is you're saying everybody applies for this. So TILA puts advertising restrictions on the lenders. Specifically what they say when advertising, first off, with TILA, we need to make sure that the consumer is fully informed of what's known as chief disclosures. Chief disclosures include the annual percentage rate, APR, annual percentage rate. The annual percentage rate is financing the entire loan. It's all the numbers of the loan. It's more precise than the interest rate. The interest rate is included in the APR. So the interest rate tells you the interest you're going to pay when you borrow back. The annual percentage rate, the APR, looks at all of the numbers of the loan. So chief disclosure on the loan estimate, it's going to include the APR, financing charges associated with the loans, the number and amount of payments. If you're getting a 30-year loan, you're going to pay this every month for the next 30 years. So you're going to have 360 payments. And then the total amount that you're financed. So part of this advertising lender laws, they have to disclose the chief disclosures. They have to disclose this to the consumer. The other part of the TILA is their advertising regulations. Lenders have something referred to as trigger terms. Trigger terms are specific numbers about the loan. So if the lender advertises home loan for 30 years at 4% interest rate, they've hit a trigger term. We're going to look at some examples in just a second. In the lender's advertising, if they hit a specific number about the loan, then they need to disclose all of the terms about the loan. If they're going to advertise one specific number, they're advertising a one-size-fits-all loan. And since it all applies to us, these are the terms for all of us. This is another reason where people felt misled in the housing market crash. Lenders were advertising low interest rates, but guess what? Not everybody qualified or should have gotten those low interest rates. So now we've cracked down. In advertising, be aware of trigger terms. Again, specific numbers about the loan. We'll look at some examples. So if the lender advertises the amount of down payment, the amount of any payment, the number of payments, the period of repayment, and the dollar amount of finance charges, they've hit a trigger term. Once they hit a trigger term, they got to disclose all of the information about the loan. Somebody says that's what you're seeing in commercials. Remember, this only applies to mortgage loans. This may not be a car loan or any kind of loan. This is just mortgage loans. So if they hit a trigger term, they must disclose all the terms. They're not going to hit trigger terms anymore because loans, mortgage loans, are not a one-size-fits-all product. Yes, ma'am.
So is it saying like, you did say like if they're advertising like a certain percentage rate, is that what you're saying? So
Yep.
does
So
that
if we look
mean?
at some, so if we look at some examples, can we see the difference in 600 monthly payment advertising, get this loan and you get $600 monthly payment versus advertising low monthly payment? Which one is the trigger term? Which one is the specific number? The $600. Do we see the difference in advertising? Get this loan with 0 down versus get this loan with a low down payment. So that's what we mean by specific number about the loan versus general. They can't give the impression or the illusion that all 18 of us are going to qualify for the same loan with the same terms, with the same amount of money. That's not realistic at all. And please hear me when I say, TILA addresses specific numbers about the loan. Is the list price about the loan? No. Are the HOA dues about the loan? No. It's numbers about the loan. And I bring this up because you guys on your test, you get so excited and you see house listed for sale for $250,000. And you say, there's a specific number, trigger term, trigger term. So when you see a number, stop and breathe. And then ask yourself, is it about the loan or is it about the property? Does everybody hear me? I'm going to go back for 1 second. What are specific numbers about the loan that would trigger a TILA? The amount of the down payment, the amount of any payment, number of payments, payment, repayment period, or the dollar amount of finance charge. So again, if the lender hits a trigger term, if they hit a specific number about the loan, also included in the ad must be all the information about the loan. So if I say, call me to get a mortgage loan for 4.5% interest rate, I need to follow that with the amount of the loan, the actual number of the down payment, the frequency, number and amount of payments, interest rate, and total required payments. Restrictions on advertising to help better educate the consumer. We don't want to give any implications that the consumer can get the loan. So we're going to avoid specifics. So if a trigger term is hit in the advertising, the lender's got to disclose it all. Remembering, TRID, TILA, TILA's the T in TRID. These are all lender laws. So back to the previous question. If it's a cash buyer, lender's not involved, are they? If it's a cash buyer, TRID's not involved. If it's a cash buyer, the rule is there are no rules. All our rules, loan process, loan application is only when a lender's involved. You get to work with a cash buyer. I was fortunate enough to work with a cash buyer once. He was an investor. And I mean, the process was totally different than dealing with the lender. And I kept feeling like this was too easy. Something's missing. Yeah, a big something was missing. The lender was missing. You guys bought a home in the last 12 years? Did you get a loan? When you went to closing, they probably plopped down a stack of paper about yay thick in front of you. Said, you know, here you go. I tell my buyers to sign that, warm up their signing hand. Guess what? If you buy a house without a loan, your stack of paper is now only like maybe that big. It drastically decreased. With a loan, without a loan. How much is the lender involved? About that much. So they play a huge part of the process when they're involved. So gee, Julie, what's the big deal? Well, let's talk about this. Violations of TILA. Lenders could be looking at violations of $10,000 per day per violation. Remember the housing market crash? We don't want to be here again. How do we make sure we're not here again? We charge lenders $10,000 per day per violation when they violate TILA. Is that going to make them think before advertising the interest rate? I hope so. There could be other fines as well. The lender, if they're severe enough, may even get to go to jail, depending on the judge. So I've been babbling on and on and on about a lender law. Why do you and I care so much about the lender law? Let's talk through a scenario. Let's say you get a new listing this week. Congrats. And you decide as part of your new listing, you want to do a broker open. What I mean by that is you want to invite your fellow real estate agent peers to the house on Thursday. What do y'all want to do? Y'all want to do a wine and cheese on Thursday? Let's do a wine and cheese. Doesn't that sound nice? Okay. So you get a new listing, you do a broker open, and you invite all your fellow agents to your wine and cheese on Thursday so they can come see your new listing and tell their buyers about it. When you're preparing to do your broker open, you call your lender buddy and you say, hey, I'm doing a broker open. You want to go in on it with me? Your lender buddy very well may say, yeah. Because what a great opportunity for your lender buddy to meet agents. So your lender buddy says, that's awesome. Let me go in and I'll tell you what, I'll do the flyer for the broker open. The lender generates the flyer. They put your picture on it, your name, your phone number, your email address. And they also put a trigger term. Are you advertising that trigger term? Not by default, but isn't your name and contact information and your smiling picture right there next to the advertised trigger term? Could we too face these penalties? If we violate TILA advertising, whether you do it directly or not. So what you need to do is tell your lender buddy, that's awesome. Thank you for doing the flyer. I need to see it before it goes out, just to make sure that we're not violating, because once your name's on it, you're in it. And by the way, licensees, remember, we can also be disciplined by the North Carolina Real Estate Commission. So not only are we facing possibly $10,000 per day per violation and maybe prison time, but now they could be coming after our license too. All because you didn't proof the flyer for your broker open for your wine and cheese on Thursday. Is it worth looking this stuff over before it goes out? Everybody shake your head yes. So we are involved. Again, I'm not a lender, I'm not directly involved, but I am involved. So this is why we need to be aware. I can advertise the house. I can say this house is listed at $250,000, HOA dues of X amount, because those aren't numbers about the loan. Questions on TILA, Regulation Z. We're going to talk a little bit more about RESPA when we get into Unit 21, which is next, by the way. A couple other lender laws that we just need to be aware of, have an understanding. Lender laws, lenders have to follow Federal Equal Credit Opportunity Act. The Federal Equal Credit Opportunity Act prohibits the lender from discrimination for credit based on certain factors about the applicant. You cannot be denied a home loan or a mortgage loan because of your race, color, religion, national origin, sex, marital status, age, or any dependency on public housing. Federal Equal Credit Opportunity Act says if you're denied a mortgage loan, bottom line, you guys, it better be because your debt to income ratios don't shake out. They can't have anything to do with the people themselves. Age, by the way, is assuming the applicant is at least 18 years old. So as long as it's an adult. So who is age protecting? If the 90-year-old walks into a bank and applies for a 30-year loan, I'll let you do that math. They can't be denied a loan because of the fact that they're 90 years old. That's who age is protecting. Real estate agents also have protected classes. Some of these we're going to see again when we get to Unit 19, our fair housing unit. We're going to talk about federal fair housing, what our protected classes are. A lot of these are going to be similar. There are some differences. So when we get to Unit 19, we'll do a nice side-by-side comparison of our protected classes versus the lender's protected classes. The other thing that the Equal Credit Opportunity Act says that if you're denied a loan, the lender must inform you in writing and within 30 days of why you were denied. And within those reasons of why you were denied, it better not be because of your race, color, religion, national origin, sex, marital status, age, or dependency on public assistance. Again, if you're denied a loan, it comes down to, or should come down to, your debt to income ratio. It's just not working out. The numbers aren't crunching. The other act, the lender, or another act the lender has is the Fair Credit Reporting Act. This is what gives us the ability to check our credit reporting once a year. Who are the sources? They're in your book. I never remember these. Equifax, Experian, and TransUnion. So when we're pulling our credit report on page 410, the bottom of the Fair Credit Reporting Act, that's what we're referring to. Doesn't have to be 90, does it? Could be 17 or 18 years old. So question comes in, if the 90-year-old dies, who becomes responsible for the loan? They have heirs. And the heirs sell the house, they can pay the loan off. Somebody's going to get the house when the individual passes away. Again, doesn't matter if you're 90, it could be when you're 18 and a half too, right? So that's why our contract stipulates, for example, and even after the loan has been originated. Fair Credit Reporting Act, they're going to go back last 7 years. If you've had a bankruptcy in your history, they may go back a little bit further. So this just, again, says the right that we have to check our credit. If you check your credit once a year, you pull the 3 reports, Equifax, Experian, and TransUnion. If you find something that you didn't do, that you didn't put it on there, you have the right to contact them to try to get it cleared up. So please, if you're not in the habit of pulling your credit reports once a year, please get in the habit now. Because if you don't know what's going on with your credit and you think you're going to run out by house and they pull your credit report and somebody stole your identity, somebody created an account without you being aware of it, it pops up on your credit report, you're probably going to have to take care of it before you buy that house. So pull your credit reports now. That's why they give us the ability to do it once a year. You guys hear about kids every once in a while. Kids get their identity stolen. I've heard of pets getting their identity stolen. All you got to do is create a social security for somebody, and then poof, you got a big part of what you need. So the advice, the financial advice, is that we just get in the habit of pulling our credit once a year so we know what's on it, so we can be prepared for surprises. Financing is a lot, you guys. I get it. I'm asking you to speak. I'm just still working on teaching you guys broker. Now I'm trying to teach you a totally different language. So remember, you guys, we're not trying to make this more harder than what it is. Keep this stuff simple. We're just scratching surfaces, so we can obviously get through the tests, but so we can also assist the lender to assist our buyer client. We're all in this together to get our buyer to closing. We're a big part of that process, and a big part of the process is the lending process. So we need a very basic understanding, and that's what we're doing here. Thursday, we're going to finish up Unit 15. I got a little bit more math to do. Please bring your calculators. We're close to the end of Unit 15. Once we're done with Unit 15 on Thursday, we jump into 21. Unit 21 might be my favorite, because guess what? In Unit 21, we get to go to closing. We've worked hard for this, haven't we? We've created agency, we put them under contract, we got them financed. By golly, now it's time to get to closing. So that's what we're going to do in Unit 21, go through that contract to closing process. I'm going to stop recording, but I'm going to leave the call open if you guys want to connect, if you want to communicate about a study group, share information or whatever. I'm going to go away, so you don't have to worry about me being here. But if you guys want to stay on and connect, I'll leave the call open for that. Otherwise, you guys have a great afternoon. Please never hesitate to reach out to me. I'm always available. And I will see you guys first thing Thursday morning, 9 a.m. sharp.
Thank you. Bye.
Thank you.